like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's world headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Well, a very good afternoon, everybody. We're having a little chit-chat here in the Bloomberg.
We need a
Interactive
fifth
Broker
microphone
studio.
in here.
We do. David, don't go.
Don't go, David Weston.
David Weston, come down. Coming up, folks, it is Thursday, Friday's Eve, as we like to call it, and we're going to talk about that cooling jobs data and some market technicals perhaps at play today, Tim, especially when it comes to tech stocks. So we're going to talk a little bit about that. Tech really helping the equity market today.
Yeah, Tesla shares, though, not partaking in today's rally. Carvana shares are big time, but Carol, that stock down 98% from its all-time highs.
A little perspective on that one. We're also going to talk good business. We're going to talk sustainability, IT trends and spending, and then life expectancy. Not to be a Debbie Downer, but it's down in the U.S. post-COVID. We're going to have some thoughts on how every one of us can change that.
We're also going to get a little taste of your conversation yesterday with the CEO of Impossible Foods, Peter McGinnis, talking about plant-based food industry becoming, quote, created and established.
I forgot to ask if they're going to have an IPO, but he promised me he'd come back and talk about that.
I mean, everyone's waiting.
Tick-tock, tick-tock. All of that to come. We begin with a check on the trading day and Charlie Pelley.
Thank you
Charlie.
very much. Well, hello there. We're higher across the board. Do want to add another story to the mix that we'll likely be talking about throughout the afternoon. According to sources, the U.S. Federal Trade Commission has voted to sue to block Microsoft's $69 billion acquisition of Activision Blizzard, saying the tie-up between the Xbox maker and popular gaming publisher would harm competition in the gaming market. It's a headline right now on the Bloomberg Professional Service, the story we're monitoring. Right now we have got shares of Microsoft. They're higher by 1.3%. Activision Blizzard, though, on the minus side, down by 2.3%. Stocks are higher after a 5-day slide. Traders are awaiting key inflation numbers for clues on whether Fed officials will be able to notch down their aggressive tightening campaign. 10-year yield 3.48%, the 2-year 4.31%. S&P up 26. We're off session highs right now, still up 0.7%. The Dow up 162, up 0.5. Nasdaq up 111. That is a gain of 1%. Gold up $3 the ounce to $17.89, up 0.2%. West Texas Intermediate crude oil is lower now by 0.1%, 71.93 a barrel. Well, one of the big questions for economists, strategists, and traders is assessing the odds of a U.S. recession. Lori Heinel is Global Chief Investment Officer at State Street Global Advisors.
Well, we're quite concerned, and not because we think it's inevitable, but the longer that the Fed continues to have to tighten policy and the longer that inflation prints remain high and things like job markets remain strong, at least on the surface, the risks of that recession are real, and we're seeing that reflected in long bonds.
ExxonMobil is raising its annual share buyback by about 10%. ExxonMobil shares up now by 1.2%. Yesterday, they were talking about raising salaries. Airbnb, meanwhile, blocking some users from booking single-night rentals of entire properties as part of the home-sharing platform's push to prevent parties on New Year's Eve. Right now, Airbnb up by 3.5%. That, my friends, is a Bloomberg Business Flash.
All right, Charlie, thank you so much. All right, let's get to it. Let's get to the Market Drivers Report. Let's hit the Business Week agenda on this Thursday, a.k.a. Friday's Eve. In the house, Michael McKee, International Economics and Policy Correspondent at Bloomberg News, along with Abigail Doolittle, Markets Reporter at Bloomberg News. Where shall I begin? This is like picking your favorite child.
Miny, mo.
Mike, I am going to start with you. Forgive me, because talk to me about the economic backdrop, because I do feel like we're very focused on data points and what that might mean for the Fed meeting next week.
This has been a boring week because we haven't had a lot of economic data points. We had jobless claims today. They came in as expected. No real changes. It's also seasonal adjustment problems around the time of Thanksgiving, so nobody's paying them a
Even
lot
the continuing
of mind.
claims, like I felt like they were like
Well, continuing claims is a week delayed, so that's the week of Thanksgiving. So it's kind of hard to tell there. I mean, they've gone up a little bit, suggesting maybe it's a little bit longer to get a new job, but not so bad. But starting tomorrow, we get PPI, which is a lesser of the inflation indicators. But then next week, of course, CPI and the Fed meeting. And so we're going to go from the hammock to the fire, not the frying pan to the fire, but
the hammock to the fire. I've never heard that.
Yeah, I just made that up.
You should copyright that.
I'll use that
Do you
later.
fall out of the hammock? Do you get up gracefully?
Well, we are seeing a wage price spiral, though.
Yeah.
In the economy. The San Diego Padres signing Xander Bogaerts.
I was wondering where you were going with this because I thought we weren't seeing a wage price spiral except for
in baseball.
MLB.
We are. San Diego Padres signed Xander Bogaerts. He made $20 million last year, and he's going to make $25.5 million next year.
Okay.
And the Padres have raised ticket prices 18%.
You know, in 7th grade, we learned that these are called outliers when it comes to, large swaths of data.
Well, then there is Aaron Judge and the Yankees.
Oh,
What is
okay.
that, a 5 or 10-year deal for $360 million?
10 years, yeah.
10 years. That's
Exactly.
pretty decent.
But the thing I said to
But
Tim
he's worth it.
and Carol is he got dissed by the Yankees because he hit 63 home runs, so he got 111% raise. But when Roger Maris hit 61 home runs, he got 19% raise the next year. He went all the way from $32,000 a year to $70,000 a year.
Jeez Louise.
Wow.
So I mean, how can
Yeah.
you got to figure that Aaron Judge is upset by the fact that he'll only make $40 million.
He's
a year.
crying at home.
Yeah, I'm
He's
sure.
crying at home.
I'm sure he's so upset.
Our Ariel Agami is saying it's $360 million for 9 years. So
9 years.
You know, when
Oh,
we're
that's a
talking-
quick.
Did I get it right? Okay. All right. So come on in, Abigail. I'm looking at the equity trade. We're just rolling over, so we're coming off our best levels of the session. Still green, but just barely. It feels like.
Yeah, the S&P 500 up about 0.4%. The first up day right now in 6. Let's see if we hang on to these gains because to your point, we are off the highs, and that's more so for the tech-heavy Nasdaq. That index had been up more than 1% not so long ago. A big piece of the strength, once again, China tech strength. Yesterday, it took a breather on those weak import-export numbers out of China, but up 5.4% right now. All of the usual suspects there. It's hard to make too much of today. Next week, we're waiting for that CPI data and the Fed. So, you had 5 down days, so it makes sense that you're going to see a little bit of a bullish snapback. There's something that I would like to emphasize, which I think I talked about the other day, but the idea that the Dow is outperforming this year significantly. The Dow is down about 6%. The S&P 500 down only 16%. Down 16%.
And it was
The
down more than 20% a few weeks
at
ago.
one point, yes. And the NASDAQ 100 still down more than 25%. The Dow is above its August high. It is above its 200-day moving average, perhaps suggesting maybe that the S&P 500 could follow suit. And another reason to maybe think that is you have the German DAX doing something similar. You have the HXC, that New York, or the NASDAQ Golden Dragon Index doing that. When you have a number of indexes starting to break out, it's harder to see the S&P 500 hanging back. But yet, most strategists on the street right now seem to be calling for this new low. I think that right now, unbelievably
Jim
difficult
Paulson
to
is
call.
talking about 5,000 for next year.
Okay, so then
That's an outlier, though.
Okay, so there's
tends
your
to be pretty bullish.
Yeah, that is very bullish.
Well, Andrew Judge has got to put his money somewhere.
Hey, there's hope
Aaron.
for
There you
crypto.
go.
Hope for-
Arson Judge.
Crypto could bounce back too. There's a lot of things.
Hey, Mike, I want to go to tomorrow's preliminary University of Michigan sentiment figure. We saw what this did a few months ago.
You're stuck on sentiment right now.
I am, and I am because
He's a sentimental kind of guy.
I really am.
Wah, wah, wah.
But we did see what it did over the summer to the Fed and the way the Fed cited those figures. How should we read into tomorrow, especially ahead of Wednesday?
Right now, the expectation is we're not going to see. I mean, the figures you're citing are the inflation expectations, I guess, in the Michigan survey. We're not expecting any change in that, and it would be good news for the Fed if they went down a little bit. But they've stayed relatively benign. They went up to 4.9% last month for the 1-year inflation, but the 5-year inflation people still think is 3%. So consumers are thinking that prices are going to go down, that the Fed is going to be successful. So watch those and watch the differential between them. If they don't change a whole lot, that's relatively good news for the Fed.
Hey, one last thing, Abigail, VIX, something you've been keeping a watch on. Anything of interest there?
Yeah, I'm so glad that you asked that, Carol, because prior to the S&P 500, or around the time when the S&P 500 was taking out that 200-day moving average, more interesting in a way was the VIX, because it's been in this range between, let's just call it 20 and 35 or so. And the VIX range broke briefly to the downside last week, but it's right back up in there. And the range actually looks pretty good. Now, it's funny, with that Dow breaking out that way and these other indexes, I tend to think that the consensus call right now for a dip and then some sort of rally later next year, I don't know, may prove to be challenged. I almost feel like we're going to get some kind of pop here, a really difficult one, and then maybe a big decline next year.
I just want to know about, Mike, your 9-year contract. Or Abigail, your 9-year contract.
I wish it was like Aaron Judge's 9-year contract.
We were actually talking about this yesterday with your
spiral?
producer, Paul Brennan, is how what's happening is all these superstars sign. They get these huge contracts, and then it pushes up the salary for everybody else. So Carol's going to enter free agency.
Oh, perfect.
And get a huge contract. And they're going to have to come back and offer you a much bigger salary so that you won't lose.
I think I got an agent in Michael McKee right here.
Because
I'm a team player.
They can't sell tickets if you leave, you know?
All right,
I hope my bosses are listening.
As we go, ha, ha, ha. All right, we got to run. Michael McKee, Abigail Doolittle, guys, thank you so much. Really appreciate the setup here on this Thursday. All right, we got more Fed talk we want to get to.
Yeah, well, speaking of the Fed, it's not really succeeding when it comes to its dual mandate. Yes, unemployment is low, but inflation remains sky high. That said, its monetary tightening campaign is having a major impact in deflating asset bubbles that just swelled during the pandemic. I mean, we're talking crypto, housing prices, tech stocks, and it's doing so without upending its financial system. Rich Miller writes all about it. He's Bloomberg News economics reporter. He joins us via Zoom from Washington, D.C. Rich, good to have you with us this afternoon. So take us through the metrics that you looked at when you talk about deflating asset bubbles here.
Well, I mean, obviously the one that is topic du jour at the moment is crypto, right? And that's, depending on how you measure it, it's the market cap of crypto is down about 2/3 from like $3 trillion high not too long ago. If you go look at the FANG stocks, they're down about more than 50%. NASDAQ is down less than that, but NASDAQ as a whole. But if you look at the FANG stocks, they're down by more than 50%. And the house prices, they're just starting to tick over, but this is the first time they've basically started to decline in 10 years. So all across the board, we're seeing sort of pretty weak asset prices. And if you had, told people, that the Fed was going to raise rates so aggressively a year ago, they would have said, "Oh my God, we're going to see havoc in the financial markets. You're going to see firms going bust. You're going to see bank runs. You're going to see et cetera, et cetera." None of that has happened. The air is coming out of these bubbles, but so far, and that's a big proviso. So far, it hasn't really, shaken the financial system like we saw in, the great financial crisis.
Yeah, it's interesting. I mean, even looking at something like commodities, they're down about 19-20% from their high back in June, and some of that's geopolitical, Rich. But you do wonder, right? Like, it makes you think, might the Fed, FOMC, Jay Powell and company be able to engineer that soft landing?
Yeah, I mean, it increases the chances, right? Obviously, if you really saw havoc in the system, we'd be heading into a recession very clearly, and probably a deep one, and the Fed would have to be cutting rates a lot. But so far, they've been able to keep raising rates without sort of causing so much havoc in the financial market that they'll have to stop or retrace. And I've got a quote in there from Jeremy Stein. He's an ex-Fed governor, and he said, if you had told me a year ago that they were going to be raising this, I'd say, oh my God, you're going to crack everything up. But so far, we haven't.
Is one of the reasons why this is kind of okay is because it goes to what's referred to as the wealth effect. When people's assets decline, they tend not to spend as much money on large purchases. But it's not huge though, right?
Yeah, I mean, I think the economists say it's, for every dollar fall, it's only like a couple of cents off consumption, basically, right? It might be a little bit.
But does that have an effect to bring down inflation?
Well, that'll be one factor contributing to a slowdown in consumption, and that's what the Fed wants, consumption to slow, demand to slow. So that's one of the vehicles. But I guess the main vehicles are what you'd see, your higher borrowing costs, right? So housing, buying less, fewer cars, buying fewer durable goods. That would be the main mechanism by which the higher interest rates would slow the economy down. But peripherally, it would also, by knocking asset prices down, it makes people feel less rich. And I'm going to save a little more. I'm not going to spend that money, right?
One thing I want to ask you, Rich, and I wonder if we can't rule out some kind of financial blow up, which you point out in your story. Because, one of the things I think about, and this, I'm not saying this is a blow up, but you have Blackstone's behemoth private credit fund, hitting redemption limits for the first time in its 2-year histories, because you had investors pulling out some $50 billion from the corporate lending vehicle.
Right.
Like I saw that, and we continue to kind of figure out corporate real estate. Like, might it not come back fully post-pandemic? And so what happens? So I just wonder, is there something potentially that could still happen?
Yeah. I mean, actually, that fund, the Blackstone fund, has actually been doing pretty well. So it's not like people are pulling the money out because they
weren't getting performance.
They're losing money. Either they're pulling out to take profits, or they're pulling it out because they think maybe next year won't be so good as for commercial real estate as the dividends that they've been getting from that as last year. And that fund did have rules saying how much you could redeem. So it's I'm not sure it's a sign of financial cracks are happening. I think it's more idiosyncratic, actually.
There was a caveat in here that you made sure to say.
A lot of caveats.
As of
sign
now,
of times.
When does that caveat, if at all, come true? What do we need to look for to make sure that it doesn't upend the economy? What's the first sign?
Yeah, I mean, I wish I could tell you, and I wouldn't be talking to you guys, right? Or I'd be talking to you from a yacht, right?
We would welcome that with a great internet connection too, I bet.
Well, as we saw with the UK, I mean, where all of a sudden pension funds of all places, right? We thought these are supposed to be rock solid. All of a sudden these things can come out of the blue. I mean, the regulators are doing their best to keep an eye on everything, but it's hard beforehand. There's that Buffett saying, right? When the tide goes out, you see who's swimming naked, right? When the interest rates go up, you see who's sort of highly leveraged and who's caught with their proverbial pants down, so to speak. So
yeah.
I mean, mixing a lot of metaphors here, but anyway, still to be said. But I mean, so far so good.
All right, Rich, we got to run. Thank you so much. Rich Miller, economics reporter at Bloomberg News, joining us via Zoom from Washington, D.C. Carol Master, Tim Stanovic. This is Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. The Federal Trade Commission is seeking to block Microsoft's $69 billion acquisition of Activision Blizzard, saying the tie-up between the Xbox maker and popular gaming publisher will harm competition. Microsoft shares, they're holding on to a gain of 0.9%. Activision Blizzard down now by 2.3%. An up day for the Dow, the S&P, and NASDAQ. The S&P, however, has trim gains as investors await key inflation numbers tomorrow morning for clues on whether Federal Reserve officials will be able to notch down their aggressive tightening campaign. S&P up 21, a gain right now of 0.5%. Dow Industrials up 102, up by 0.3%. NASDAQ up 99, a gain there of 0.9%. 10-year yield now 3.48%. We've got Bitcoin up 2.3% at 17,217. Spot gold up 0.1%, 17.88 the ounce, while West Texas Intermediate crude down 0.5%, 71.64 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So we mentioned earlier, since 2019, life expectancy in the United States has declined 2.7 years. It is the largest since World War II, that decline. Black Americans lost 4 years of life expectancy, and Indigenous Americans lost more than 6. And our next guest says we can do a lot better. He writes about it in a recent article for Bloomberg City Lab.
We're very pleased to have back with us Dr. Joshua Sharfstein. He's Vice Dean for the Public Health Practice and Community Engagement and Director of the Bloomberg American Health Initiative. It's at the Johns Hopkins Bloomberg School of Public Health. It is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies, also the co-author of The Opioid Epidemic, What Everyone Needs to Know. Dr. Sharfstein this afternoon joins us on the phone from Philadelphia. Dr. Sharfstein, it's always great to get you on the program. Anyone who reads this headline would say, okay, that's just because of COVID. But you actually argue in your piece that life expectancy would have gone down even if we didn't have the excess deaths that were caused by COVID. What's going on?
Well, it turns out life expectancy peaked in the United States in 2014 and has been stagnating and even declining a little bit since then, even before the pandemic. The pandemic obviously is the major reason for that shocking decline, which is the largest decline in life expectancy since World War I, over 100 years ago. But it's not the only cause. Another major cause are overdoses. More than 100,000 Americans now dying of fatal overdoses. That's double what it was just a few years ago. And then on top of that, we see significant increases in gun-related suicides and homicides, as well as motor vehicle crashes, which are up like 30% since 2014. So there are multiple causes, but what they do have in common is that they are preventable. A lot of these deaths can be prevented if we take some basic steps, which actually have a lot of support.
And forgive me, you're right. I've misread. The largest since World War II, that 2.7 years off our life expectancy since 2019. Very, very significant. You know, one of the things that I've done some work on, and recently when the UN was in town in the fall, we did a gathering to talk about non-communicable diseases, you know, so this is something you cover too, and we're talking about things like diabetes, strokes, heart disease. This is really the leading killer in so many different countries, and I feel like we all just kind of, well, yeah, that's a part of life, but it doesn't have to be, does it?
Well, there are absolutely ways to reduce premature deaths from cardiovascular disease, diabetes, and other non-communicable diseases. In the report, we talk about the value of controlling salt intake. And most of the salt we take in is already in our food. It's not the salt we put on with a salt shaker. And getting the salt down in that food could make a big difference. I think it's estimated saving 50,000 lives a year. That's my understanding. So it's really important not just to think of this as, you know, eat healthy, but how do we get healthy food to ourselves and to other people?
So we've covered food. I want to go to overdoses. You're the co-author of The Opioid Epidemic, What Everyone Needs to Know. We know that over the last few years, opioid overdoses here in the United States have skyrocketed. What is the best way to address this?
So I think you have to start with what we know, and what we know works. And one of the most effective treatments for opioid use disorder are medications like methadone and buprenorphine. They reduce the chance of death from any cause somewhere on the order of 75%.
Are these medications, forgive me, but are these medications that people take if they are unconscious, like through their nose, or these medications that help?
No, it is not. No. Naloxone is what resuscitates you. But then the problem is, if you still have addiction, if you're still addicted, it is quite likely that you will go back to using opioids, because that is what your brain is really compelling you to do. So what buprenorphine and methadone do is really address that craving. And people say, aha, I can be myself again. I remember one person who we interviewed who said, I felt like I was married to heroin until I got on treatment with methadone, and then I could get a divorce. I thought only suicide would be my out. That was the only way to get away. But it really addresses the problem in the brain from addiction, really helps people put their lives back together, and dramatically reduces the risk of overdose death. And unfortunately, fewer than 1 in 5 people with opioid use disorder actually get these medicines. Many places don't offer them. Many emergency departments, despite evidence that starting treatment in the emergency department will double the success of staying in treatment at 1 month. That was a very well-designed randomized controlled trial. Despite that evidence, a lot of places don't offer it. So we say, look, let's make that the standard of care, not just in emergency departments, but also in jails and prisons, where people can get started on treatment and not only dramatically reduce the chance they'll die when they leave detention, but also dramatically reduce the chance they'll commit another crime, associated very clearly with lower recidivism.
Can we talk about gun shootings and full transparency? We know Michael R. Bloomberg, very dominant when it comes to gun violence prevention, and he established Everytown for Gun Safety, the largest advocacy group, back in 2014, and has donated money to it. Of course, Michael Bloomberg, the founder of Bloomberg LP and Bloomberg Philanthropies. But gun shootings, it's kind of almost sad that, I don't know that we're getting used to it, but it just feels like gun shootings are very, very commonplace in the United States. That's another big reason why life expectancy has gone down.
That's right. 47,000 gun-related suicides and homicides. And they are preventable, and there are particular policies that really do work. And some of them have been adopted by states across the political spectrum. I remember after the Parkland shooting, there was a lot of cynicism. People said, well, we've seen this movie before, nothing's going to change. But those young people got involved, and before you know it, a very red state, Florida, passed a law called Extreme Risk Protection Orders, basically making it possible for people to temporarily lose access to their guns if they're behaving dangerously and are a risk to themselves or others. And that was passed in Florida, and those laws indicates the evidence so far, for every 10 to 20 of those orders issued and temporary removals of guns happening, a suicide is prevented. And there are many examples of people who were potentially going to kill someone else, or even mass shootings, who this was a tool that kept everybody safe. Those laws are in 19 states in the District of Columbia now. Our report says let's put them everywhere. And in fact, Congress, in its incredible, gun legislation, I say incredible because people didn't think anything would pass, actually provided money to help implement these laws. And good implementation of these laws, where people know how to use them, really matters in preventing those suicides and homicides. The other policy that we write about has a lot of evidence behind that, and that's requiring a permit to get a firearm. It's a permit to purchase, and those laws are associated with fewer suicides, fewer homicides, and fewer mass shootings.
What about when it comes to policies around driving? Because motor vehicle deaths are another reason why we see a decline in life expectancy. You argue that these are preventable. How do cities and states prevent these?
Yeah, they really are preventable, and there are different kinds of strategies. One of them that we mention in the report is additional technology to keep people who are inebriated from driving. Reducing drunk driving is really important because it's responsible for so many deaths on the road. And right now there is work to create new technology in cars that keeps people from driving who are drunk. And if people can roll up their sleeves and get that technology to work, that could be very impactful. The other kind of solution we talk about is redesign, looking for where those crashes are happening. When you see multiple little memorials on a particular corner, someone has to ask, or at a particular bend in the road, like, is something wrong with the road? And when you redesign to make things safe for pedestrians, safer for bicyclists, then you actually do see fewer motor vehicle related fatalities. And that can be a real strategy for reducing death.
And I should be, again, full disclosure that Bloomberg Philanthropies has also been working to save lives and reduce injuries, I should say, from traffic crashes. And they've been doing this around the world. Dr. Joshua Sharfstein, thank you so much. Vice Dean for Public Health and Practice and Community Engagement at Johns Hopkins Bloomberg School of Public Health. He is also Director of the Bloomberg American Health Initiative, also at Johns Hopkins, joining us on the phone in Philadelphia. All right,
Go ahead, Joe.
You're listening to a Bloomberg Business Week. Let's get a check on world and national news. Nancy Lyons in D.C. Hey, Nance.
Thanks, Carol. A prisoner swap between the U.S. and Russia means WNBA star Brittany Griner is heading back to the U.S. The U.S. is releasing notorious Russian arms dealer Victor Bout in return. President Biden says he has spoken to Griner and she is safe and on her way home.
This is a day we've worked toward for a long time. We never stopped pushing for her release. It took painstaking and intense negotiations, and I want to thank all the hardworking public servants across my administration who worked tirelessly to secure her release.
The president says the administration is still negotiating for the release of American Paul Whelan, who is serving 16 years in Russia on spying charges. The UK, France, and Germany are condemning Iran for executing a 23-year-old protester today, a move that signals the Islamic Republic is significantly escalating its crackdown on anti-government unrest. President Biden says he will move quickly to sign a bill protecting the right of same-sex marriage. We get more from Bloomberg's Irv Chapman.
Judiciary Chairman Jerry Nadler is a longtime sponsor of the bill.
I'm very proud that marriage equality will be enshrined in law.
Ranking Republican Jim Jordan said same-sex marriage is not under threat of being overturned.
This bill is simply the latest installment of the Democrats' campaign to intimidate the highest court in our land.
The yeas are 258. The nays are 169. The motion is adopted.
The Senate added a provision to allow religious organizations to deny services to same-sex couples, and that won enough Republican votes for passage. In Washington, Irv Chapman, Bloomberg Radio.
There's been another attack at a Duke Energy facility, this time in South Carolina. Officials say there was no property damage or injuries from shots being fired at a hydropower plant in Ridgeway. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. Stocks are off their highs with the 10-year yield hitting 3.5%. Stocks of trim gains as investors await key inflation numbers tomorrow morning for clues as to whether Federal Reserve officials will be able to notch down their aggressive tightening campaign. We have got the 10-year now yielding 3.49% with the 2-year at 4.31%. S&P 500 index again off session highs but still up by 21 points right now, a gain of about 0.5%. The Dow up 94, up 0.3%. NASDAQ up 100 points. That is a gain now of just about 0.9%. Spot gold up 3.28 the ounce now to 17.89, higher by 0.2%. West Texas Intermediate crude down 0.7%, 71.53 a barrel. Well, as for the Federal Reserve and the outlook for interest rates, Anastasia Amoroso is Chief Investment Officer at iCapital. She was interviewed this morning on Bloomberg Surveillance.
We sort of know what the rules of the road are, and we know what the Fed is trying to solve for. We know they're trying to accomplish below, potential growth, and they're trying to bring down inflation, and they have to get rates to 5%. So, everybody sort of knows the formula, and I think given the variables, that's what we're solving for.
American Express Global Business Travel says airfares will increase around the world next year by as much as 12% on Europe-Asia routes and 10% for North America-Asia flights. We've got U.S. carriers, which have significant international operations. UAL down 2.9%, American up 0.3%, Delta down 2.4%. Rounding out some of the other domestic carriers, Southwest down 0.7%, JetBlue down 3.3%, and Spirit reaching a deal with its pilots down 1.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, the new issue of Bloomberg Business Week is out, and this week's issue has at least a bit of good news for readers and listeners. It's the 9th annual Good Business issue featuring subjects from tackling inequality to saving the planet with more sustainable practices.
Bloomberg Business Week Solutions and Strategy Senior Editor Rebecca Penty oversees the issue. She joins us on the phone from London. Rebecca, I want to get to some of the stories in just a second, especially the cover story. It's close to my heart because I'm a subscriber to Misfits Market. But let's talk a little bit about your thinking behind the issue and how you approached it this year.
Yeah, so I think every year we're looking for uplifting stories to tell about how business can be a force for good in the world, which isn't always something people think about. I mean, oftentimes people think about CEOs just out to make a quick buck, or thinking about shareholder returns as being the be-all, end-all. And I think this year our issue is landing at a time that's just perfect, because we've got inflation soaring, we've got job cuts that are starting to trickle through, and we've got some skepticism out there about ESG investing. And most recently, whether CEO philanthropists really are all they're cracked up to be. The case of FTX crumbling and Sam Bankman-Fried's effective altruism movement, really becoming tainted. So I think the issue is really timed well in providing readers with some uplifting stories about people, about leaders who actually are doing some really positive work and deserve some attention.
All right, well, let's talk about one of those leaders, and that is the leader at Misfits Market, and that is the cover story. Tell us about this. I'm not familiar with him, but Tim says he's a pretty active user.
I got to tell you, Rebecca, I was exactly the person you described in this story. We didn't subscribe until lockdown hit, and that's when we know, thanks to the story, Misfits went into overdrive. And I remember getting an email from them saying, hey, you're not the only one. We are overwhelmed. You're on a wait list, but we'll try to get you in.
I think that's when a lot of people started subscribing to online groceries. It was the same for me. May 2020 was when I started as well in London. And this is a really fun story about, a founder who is now 30 years old, the son of immigrants from India, and, whose parents taught him the value of not wasting food, about, eating. One of the anecdotes is his parents wouldn't let him throw an apple away until he'd eaten all the flesh around the core. And so he started this Philadelphia-based online grocer in 2018, and he was stocking oddball-shaped fruits and vegetables, things that were either too big or odd-shaped that the grocery stores wouldn't sell in his living room of his apartment that he shared with his future wife. And it really grew from there. And SoftBank is an investor. He's got $525 million of venture capital funding, and he's taken this thing national. And that means, a lot of growing pains, a lot of trying to sort out how does he stick to that mission of providing people with organic, produce, trying to keep food out of the trash, with also trying to meet those national needs, sourcing all of the supply and providing customers with things that they want, because people are counting on being able to order what they want when they want. And that doesn't always line up with dealing with food that would otherwise end up in waste.
Rebecca, as we said, this is one of the stories that makes up the cover, if you will, and the cover theme of Good Business. But I do wonder, when you talk about misfits, there's lots of transparency, and it does look like this is truly, when we think what maybe ESG should be, this is what it kind of, you would think it would look like. Having said that, is the business sustainable? Is it viable? Because it sounds like they're growing like crazy.
I think that's the big question that the story isn't quite able to answer, because they're just in the middle of scaling up. So, I think some of the risks that we point out is that they're investing a lot. The capital investment in terms of facilities, technology, people, even just investing in relationships with all their suppliers. And it's a famously scrappy, difficult space to crack, because if you're going into the very urban areas, then it's easy. But if you're going to rural places, the CEO acknowledges that they're losing money in some of their routes in order to just gain those customers. So it's certainly a risky bet, and we don't have all the information, because of course they're not going to share everything with us. But I think it's and I think also it's disclosing that not every single bit of produce is going to be oddball when you're growing that big and when you're trying to meet.
That's what Tim was like.
That's what
it's
I
not
said.
all misfits.
That's what I said. I said we rarely get something that looks funny. Oftentimes stuff is small. But speaking of solutions, there's a lot of stuff in need of solutions here. It is the solutions issue. Healthcare is one of those things that needs fixing. John Tozzi has a story in the current issue all about how JP Morgan is still trying to fix healthcare even after Haven, which was that thing that it tried with Amazon and Berkshire Hathaway, failed.
Yeah, I think this is fascinating, because it's our example of a really massive company that is looking at an issue that's really important for society. Healthcare costs are just ballooning in the U.S. No matter how much employers throw at it, the cost keeps climbing, and a lot of it's structural. These are issues that are different in different countries, but in the U.S. in particular, doctors are prescribing medications that cost more money. Insurers are having to pay more for those medications. So what JP Morgan is doing is something that others have tried before, including JP Morgan previously with Haven. But they're trying to really serve their own employees on the ground and prevent issues. So they've got, clinics near their office in Ohio, in Columbus, Ohio, and they are trying to make sure that their employees are building relationships with those medical professionals, so they will go get seen at the first indication that something is wrong and actually prevent those big issues.
Because Rebecca, fake chocolate? That seems like a crime. Quickly.
I know. When our reporter, who's actually based in Madrid, pitched this to me a few months ago, I thought, really? What's the problem with chocolate? And I felt super ignorant when I learned about all the terrible problems with chocolate that I feel like I should have known. But it's, chocolate is, cocoa farming is a huge cause of deforestation and child labor. So there are a few upstarts, and the one that we feature is called Win-Win Food Labs. They're based in London, and they use fermented barley and carob to produce chocolate. And they're using a lot of the same technologies that the vegan food industry uses to take those flavors that chocolate is famous for and tease those out using other ingredients.
Love the issue. I feel like we all need a little good business right now, and you guys give us so much. Rebecca Penty, Solutions and Strategies Senior Editor at Bloomberg Business Week. The Good Business Issue, it is out on newsstands, online, and always on the Bloomberg Terminal.
It is 2:53 on Wall Street. I'm Charlie Pellet with today's company headlines. Federal Trade Commission is seeking to block Microsoft from acquiring Activision Blizzard, alleging it would, quote, enable Microsoft to suppress competitors to its Xbox gaming consoles and its rapidly growing subscription content and cloud gaming business. Microsoft shares now, they are trading up by 1.2%. Activision, though, remains lower now by just about 1.7%. And its rapidly growing subscription content and cloud gaming business. Microsoft shares now, they are trading up by 1.2%. Activision, though, remains lower now by just about 1.7%. ExxonMobil is raising its annual share buyback by about 10% this 6 weeks after the oil giant posted its highest profit in its 152-year history. Yesterday, the company announced salary increases for corporate office workers. We've got shares of ExxonMobil up now by about 0.4%. British American Tobacco says U.S. consumers are increasingly switching to lower-priced cigarette brands as higher living costs reduce the disposable income. British American makes cigarette brands such as Lucky Strike, Camel, and Newport cigarettes. Shares lower now by about 2.6%. The Keystone Oil Pipeline System, a major conduit linking Canada to the U.S. Gulf Coast, was shut down after crude leaked into a creek in Kansas. Pipeline owner TC Energy said the incident occurred about 20 miles south of Steel City, Nebraska. TC Energy has declared force majeure. It is an update on Wall Street. Coming up, we will recap the markets for you with the Dow, the S&P, NASDAQ, all advancing. S&P up by 0.7. Those are company stories we're following. I'm Charlie Pellet.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, more Business Week to come in just a moment. First up, let's get a check on world and national news. For that, it's off to D.C. and Nancy Lyons. Hey, Nance.
Thanks, Carol. The White House says Brittany Griner is in good spirits and is in generally good health. She was released from Russian custody as part of a prisoner swap. Meanwhile, National Security spokesperson John Kirby tells Bloomberg the U.S. is not giving up on bringing back retired Marine Paul Whelan as well. He's in Russian custody, charged as a spy.
We're working on Mr. Whelan yesterday. We're working on him today, and I can guarantee you tomorrow and every day after that, we're going to continue to try to find a way to get Mr. Whelan back home with his family where he belongs.
Kirby says the deal to bring back Griner was the only deal at the time. Another attack is being investigated on a Duke power facility, this time in Ridgeway, South Carolina. It comes just as power was restored in North Carolina following a shooting attack on 2 Duke substations. Former Homeland Security Secretary Jay Johnson tells Bloomberg these attacks on the electric power grid are exposing one of the nation's vulnerabilities.
I don't know that we can have 24/7 armed guards around every substation in America. The key has to be redundancy. It shouldn't be the case that an attack with apparently rifles on 2 substations, takes out as many as 75,000 households.
Former Homeland Security Secretary Jay Johnson speaking on Bloomberg's Balance of Power. No damage or injuries have been reported in today's South Carolina attack. Well, the House has passed a bill that would provide federal protection for same-sex marriage. The vote was 258 to 169, with 39 House Republicans voting in favor. The bill now goes to President Biden to sign into law. Democrats had raised concerns that the Supreme Court could reverse rights for same-sex couples after it overturned the Roe v. Wade decision that legalized abortion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. Now back to you, Carol and Tim.
All right, Tim, thank you. Right, Nancy. Sorry.
You were looking at me.
I was
we were
looking
thinking
at
about
you,
Nancy.
Thinking Nancy. Nancy Lyons in our D.C. newsroom. Carol Massar, Tim Stenovic here in our New York newsroom. A couple things we just wanted to bring to your attention. First up, FTX's new CEO and bankruptcy lawyers met with Manhattan federal prosecutors investigating the cryptocurrency exchange's collapse and allegations that it misused customer funds and lost billions of dollars, according to people familiar with the matter. So we're kind of monitoring that.
Yeah, this is a Bloomberg exclusive. We're talking about John J. Ray III, who was appointed FTX's chief executive officer last month. He met this week with the U.S. Attorney's Office for the Southern District of New York. Lawyers for FTX from Sullivan and Cromwell, including former SEC Commission Enforcement Director Steve Paikin and former Manhattan federal prosecutor Nicole Friedlander, were also present, the people said.
And even though we don't know details of the meeting, it does suggest potential overlap between the criminal investigation and bankruptcy probe. So that is going on. In other legal news, if you will, John Paulson, you know, the huge hedge fund manager, he is seeking to shut down his wife Jenica's lawsuit, accusing him of shielding billions of dollars in assets from their divorce, claiming she's the one who engaged in a, quote, selfish money grab.
Lawyers for Paulson, who's 66 years old, will appear in court on Thursday, to urge a New York judge to dismiss his wife's suit. In court filings, they say that Jenica Paulson knew all along about trusts that she claims he used to hide assets because they were included in nearly 2 decades of joint tax returns that she signed.
Paulson filed for divorce from his wife of 21 years in September of 2021 in New York State Court in Long Island. Her July suit seeks at least $1 billion in damages, claimed he used a group of handpicked advisors, to establish 3 irrevocable trusts to ensure that she didn't get her share of assets. But man, when these really wealthy people get divorced, it gets a little ugly.
You want to hear about some of these assets? Okay,
Yeah.
He's got a net worth of $4.6 billion. The family has a bountiful portfolio of real estate, including an Aspen, Colorado ranch formerly owned by Saudi prince and an estate in the Hamptons.
So is the real estate, man. It's really cool stuff. All right, coming up, we're going to head over to our TV colleagues, talk about the markets. That's coming up in just a moment, right here on Bloomberg.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. About 60 minutes to go in the trading session on Thursday, Katie. Romaine Bostic here alongside Katie Greifeld. We're joined by our colleagues Carol Massar and Tim Stenovic. A welcome to our audiences across Bloomberg Television, Bloomberg Radio, Quick Take, as well as on YouTube. 5 straight days of losses, Carol. $1.3 trillion in market cap erased from this market. Looking to claw back some of that today.
Yeah, just barely, right? But it's some volatility here. We're off our best levels of the session when it comes to the equity trade. But we did see certainly investors earlier in a big way, it seems, pouring into technology. The other thing they seem to be pouring in is Chinese internet names. So those tech names and also Chinese gaming stocks. If you look at the NASDAQ Golden Dragon, up another 5.5% in today's session. You've got Baidu up about 4.5%. You've got Bilibili, that's a video gaming company. That is up almost 6%. And then Melco Resorts, they're a Hong Kong-based casino company. They're up almost 12%. This has to do with Macau optimizing COVID-19 testing measures for visitors from China, Hong Kong, and overseas. China continuing to ease on COVID zero, but you know, you have to wonder, Tim, easy on COVID zero, does that mean there's going to be a surge in cases and then that will ultimately lead to some more lockdowns? Time will tell.
Yeah, that's a really good question. At least today, investors are optimistic that it will be good news for some of these casino operators. I'm going to build on what you said, Carol, and talk about Las Vegas Sands, MGM Resorts, Wynn Resorts, and Casinos, all up on the day today as a result of Macau officials saying that they will relax COVID testing rules for Chinese and overseas visitors. Las Vegas Sands, back in 2019, got more than 60 60% of its revenue from Macau and the China area. And Wynn Resorts back in 2018 had 75% from Macau. So these companies are looking to regain that market share.
All right, we go back, of course, to the broader market here. A modest rally to be sure. But we should point out, it wasn't just 5 straight days of losses. I mean, we didn't even open higher really on any of those days. We did open higher here today, up about 3 to 4/10%. We were higher by as much as 1%. Split the difference right now, 0.5% on the S&P, 0.2 on the Dow, about 0.9% on the NASDAQ, and the Russell up about 0.4.
And if you look under the hood at what is powering those gains, it's technology. That sector up over 1%. You've got 9 sectors in the green right now, 2 in the red. Energy, once again, at the bottom of the pile. This is actually the 6th straight day of losses for the energy sector in particular. That is the longest streak since August 2021.
A lot of people, of course, look to the Dow and the transports for some sense here of that cyclical rotation. Actually, look to the semiconductors. NVIDIA shares up about 5.5% here on the day, as a lot of the chip stocks now getting rebid here. 2 interesting stories. We talked about this last night after the bell. Rent the Runway earnings came out. Of course, a stock that had been beaten down. It is now up 70% here on the day. This is still a $2 stock, reflective here of the drawdown that we saw earlier this year. But improving revenue, improving margins. Maybe there is a longer-term story here for Rent the Runway, and maybe there is a longer-term story for Express as well. Of course, this is the retailer that's also been on the ropes. Those shares up about 40% here on the day. This after announcing a partnership with WHP, which is one of these kind of WHR, excuse me, which is one of the conglomerates that kind of takes over other brands like Toys R Us, Anne Klein, Lotto, Joseph Abboud. So maybe there is a little bit of hope for this longer term if the folks over at WHP can figure out what to do. And Sinclair Broadcasting down 4% here. This is on the back of a downgrade. Less concerned about the stock and more concerned about some of the commentary in that report, which talked a lot about a slowdown in ad spending heading into next year. That economic softness is a big part of the story here today. And of course, we started off with that weekly jobless claims report. More importantly, though, is that blue line on your screen right now. The trend that we continue to see higher, Carol, in continuing claims. It's now been on a pretty significant trend, and based on some measures, and I'll give a hat tip here to Cameron Krice, if you look at the differential of where we were last year to where we are now, that differential seems to be, at least on a historical basis, a harbinger of recession.
Yeah, kind of interesting. So softer jobs market. Could it be that the Fed is ultimately figuring out how to engineer that soft landing? Former Fed Vice Chair Alan Blinder, he was talking to David Weston earlier on Bloomberg Television and Bloomberg Radio. He got into the Fed and the FOMC really understanding that they know that they can't overdo it, and that plays into maybe engineering that soft landing. Here's what he had to say.
If they're not cognizant of the long legs, they'll go too far and cause a deep recession. It's real. To me, it's very, very encouraging to hear the central bank saying that. They're aware of it, and they know that that's a danger, and they're trying to avoid it.
And of course, that's former vice chair of the FOMC, of the Fed, Alan Blinder, talking to David Weston. But, I do think about, Tim, that this whole idea, and this is why that Fed meeting, that last one of the year next week, is so important. Do we get some more indications that the Fed is saying, we get it, it takes time for policy to impact the economy. We want to be very careful we don't overdo it.
Yeah, and there's a great article today. We spoke to Rich Miller a little earlier. He's economics reporter for Bloomberg News. And it's all about the way that the Fed has actually succeeded, Romaine, in deflating some of these asset bubbles without actually blowing up the economy. I mean, we're not just talking crypto here, but we're also talking about tech stocks coming off their highs last year, and then the housing market as well. And so far, I mean, Carol had a good question. Does this mean that, there could be one for Team Soft Landing? And it remains to be seen, but it's a pretty good sign.
That was a fantastic story, and Rich is great. But after I read that story, I got on the phone with 2 folks because I was curious whether financial conditions were really as tight as I think some people make them out to be. And they pointed me to a couple of charts, which actually showed that financial conditions actually started to ease a little bit here into this tightening cycle. The idea, though, is that a lot of the tightening in financial conditions sort of front ran the Fed, and you can sort of look that on a chart and see that it actually really sort of dipped even before the Fed got to that first meeting in March where they hiked rates. But I wonder if that becomes a conundrum, that if folks start to feel like the Fed's ready to pause or pivot, then financial conditions just start to ease, and it kind of erases some of the Fed's efforts.
And if you think about what financial conditions are, of course, it depends on what measure you're looking at. But if you're looking at market-based measures, and the only thing the equity market is really, really bullish about is the idea of a Fed pause and then a Fed pivot, to that point, I mean, it does seem like that would cause another big easing in financial conditions, and by some measures, we're at easier levels than we were before that March initial hike.
Do you care about the PPI report tomorrow?
I care.
Yeah.
I care. Do
Well, I was
you
talking
care?
to Carol.
Oh, you
But you can answer it too. Why
You
not?
can answer
It's a
it.
free-for-all.
Everybody who cares. I mean, I care about every economic data point. I care about the CPI, when we get it next week. But I care about what the Fed ultimately has to say. Like, where do they stress the conversation next week? And I guess we're gonna have to wait and see, guys. All right, we got to wrap. We will be back in less than an hour's time. Our cross-platform coverage on radio, TV, YouTube, and of course on Bloomberg Quick Take. We will be back to count you down to the close on this Thursday with Beyond the Bell at 4 p.m. Wall Street time.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, you are listening and watching Bloomberg Business Week on this Thursday. Carol Masser along with Tim Stenovic. And you mentioned there's some headlines crossing. Did you?
Yeah, Elon Musk has responded to U.S. lawmakers in a tweet. I have not pulled up the tweet yet. I'm just looking at the headline right now. But there's never a dull moment, Carol, when it comes to Elon Musk, the way that he tweets and the way that it makes news.
Yeah, absolutely. So we'll see what he has to say. In the meantime, several Tesla stories that are out there, and we are seeing shares of Tesla down roughly 12% so far this week. We mentioned that there are things that investors are reacting today, including one on Tesla shortening production shifts at its Shanghai factory, delaying hiring as well. And then there's a story about Tesla's margin loan.
Let's bring in David Chalitzo. He's Bloomberg News corporate finance reporter on the phone from Los Angeles. Davide, it's good to have you with us this afternoon. Thanks so much for joining us. So where should we start here when it comes to the way that Tesla is thinking about its margin loan? Can you explain what exactly this means here?
Sure, and thanks for having me. So what we reported yesterday and overnight is that essentially Elon Musk's advisors and some of the banks that helped finance his takeover of Twitter are discussing new margin loans that would be provided to the billionaire backed by his holdings in Tesla to replace some of the expensive debt that is now on Twitter books. So this is a bit of replacing one kind of debt with another, but what it would mean essentially is that Musk would borrow from the banks against his Tesla stock, and some of that cash could be used to pay down the debt at the Twitter level.
But doesn't he already have debt that is backed by his Tesla stock?
Yes, he has some, and one of the questions is basically is how much capacity does he have to take more? He has, according to the latest proxy that was filed in March, about half of his stock was already pledged as collateral for loans. You may remember that in the early days of the Twitter acquisitions, there was a $12.5 billion commitment for additional margin loans that were going to help finance the deal. All of that $12.5 billion was eventually replaced by other equity commitments. So some version of that type of financing could still be on the table. He also has options that he could exercise. Of course, it depends how much of the Twitter debt he and his advisors are thinking of taking out. The most expensive and most problematic piece is about $3 billion, and that's the unsecured debt that carries an interest of 11.75%. So when you look at that from the perspective of Twitter and how he's trying to make this company, profitable and financially viable for the long term,
right,
that is clearly very expensive debt that they need to take care of.
Davide, how is this maybe a game changer or important in terms of, financially, how we look at Tesla? And what's interesting is I heard someone earlier on Bloomberg Radio talking about that the way Elon is using Tesla for Twitter, it's like using diamonds to buy pizza. And so how does, it kind of really just draws a really great picture. So how does this maybe clean up financially things potentially for Elon?
Yeah, so I think there is two sort of big questions when it comes to Twitter and Tesla and the interplay between these two of his holdings now. One is very simple. There is a concern that if he pledges more stock, Tesla stock, for these loans, that will create an overhang over lower the stock price of Tesla. Because if the value of the company declines further, it may be required by the banks to post more collateral or reduce the size of the loan. And all of those factors could impact negatively the price of the Tesla shares. And then there is another concern that's a little harder to quantify, but it has to do more with his time, energy, and sort of attention as CEO. Is he now focusing entirely on Twitter and neglecting some big issues that need taken care of at Tesla? And as you mentioned earlier, there are issues with production growth coming in a bit slower than expected. There is the semi-truck and other new products that Tesla is expected to start producing. So how much time is it going to have to take care of all of those things?
Well, this is a perfect time to bring in Ed Ludlow. He's the co-host of Bloomberg Technology. He joins us from our Bloomberg 960 studio in San Francisco. Ed, speaking of the price of Tesla shares moving lower, down 0.3% right now, but down about a quarter of their value completely since the end of October when this deal for Twitter ended up closing. What can you tell us about what we're hearing about what's happening in Shanghai, what's happening in China, and what tells us about overall demand for Tesla vehicles?
Yeah, I mean, certainly across the spectrum of retail and institutional investors, there isn't one sort of single piece of news flow that's putting downward pressure on the stock. The demand story in China is kind of up in the air. Bloomberg has reported overnight that the Shanghai plant will cut shifts by about a couple of hours and also stop onboarding new workers. And you know, this has raised questions about whether that's in response to a lack of demand. It's an interesting picture because in the month of November, actually, Tesla had a very good month, both domestically and also vehicles that are built in Shanghai and shipped overseas. But there is a lingering question. Now, I should point out, for fairness, that a spokesperson for Tesla in China said that report was untrue, but didn't say anything more about it. But I think there's a lot of, I guess, frustration that Elon Musk or another Tesla executive hasn't kind of come out to explain what the demand picture is in China.
Well, and I mean, Ed, for someone who covers this company a lot, what are your questions top of mind for Tesla going forward?
Oh my goodness, how many hours have you guys got left in the show?
Fair enough.
You know, there's a lot of moving pieces right now. The kind of key man risk question around Elon Musk is still very much top of mind because he is spending a lot of time at and on Twitter. We reported, myself and my colleagues in Asia overnight, that Tom Zhou, who was the lead at the China plant in Shanghai, is actually currently in Austin leading operations there, and he's taken a big team of engineers with him. You may have seen some unsubstantiated media reports that this individual, Tom Zhou, was going to be named as the new CEO of Tesla. Those reports were never confirmed. So there's a lot of questions about, like, who's running things at Tesla right now? How much is Musk involved? And, you know, you can't get away from the idea of the fact that this is a stock that trades at a higher multiple. You have to take into account the Fed and the impact of higher rates. And when you're a hardcore Tesla fan, that's not really a part of the conversation you go to. But if you're sort of a Wall Street mainstay investor, an institutional investor or a fund manager, there is that consideration as well.
Davide, I want to bring you back into this. I think what's interesting, and again, I heard someone talking around the newsroom, it feels like all of Wall Street, though, is involved with Elon Musk and Tesla and figuring out the debt, right? Because the lenders include B of A, Barclays, BNP Paribas, Mitsubishi UFJ, Mizuho Financial, Societe Generale, and others. It's kind of like a who's who when it comes to banking. Morgan Stanley, too, right? They're the leader on all of this.
Morgan Stanley's the lead on all of this. They have more than anybody else. They are the banks who helped put together the $13 billion of debt that Musk used to finance the Twitter acquisition. But they're in a very tough spot, too, because, as you may remember, when the acquisition closed at the end of October, credit markets were not in great shape. The banks typically sell this debt to institutional investors. They weren't able to do that this time, so they're still holding all of it. And they need to figure out a path to eventually sell it to investors. So you should look at it from the perspective of investors. All that we've seen about Twitter in the past, 6 weeks is not very encouraging, meaning that investors, especially on the fixed income side, credit investors, need to see stability, need to see a strategy, need to see a path to steady, positive cash flow going forward. And the sense we get from talking to people in this market is that right now there's just too much turbulence
Yeah, meanwhile, there's a story in the Bloomberg that just crossed a little while ago. Tesla's board is MIA, missing in action, with Elon Musk distracted and troubles piling up, which speaks to what you said, Ed. Like, how much time do you have when you think about what the concerns are, what are top of list? I mean, he's got a pretty full list. This is a man, though, I would go, that many would argue, or safe to say, that can deal, though, with a pretty full plate.
Yeah, and look, you have to also state the reality. These are a lot of negative headlines, or to be perceived as negative headlines. Tesla is still the market incumbent when it comes to electric vehicles, and they, in 2022, despite sort of enormous challenges, have got factories firing on 3 continents. And now, yes, better late than never story, but the Tesla Semi is here. They started handing over deliveries to customers. It's just that the base of support for Tesla comes from such a large body of retail investors who also own the vehicles. And what we're seeing now, the cracks are emerging because those loyalists, those big Musk and Tesla fanatics are starting to have frustration because the share price is coming down. And if you believe in an asset, no matter how much your goodwill and the stock continues to drop and drop and drop, you start to get frustrated. And it's interesting to hear those voices. And on the board point, it's not just the board. There's no PR team at Tesla. Other executives don't give interviews. We don't know who the key people are. It's Musk or nothing, and that's a problem.
All right, Tesla shares down almost 51% so far in 2022, excuse me. Davide Shaluzzo, corporate finance reporter at Bloomberg News, and Ed Ludlow, co-host of Bloomberg Technology at Bloomberg News. Thank you. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got 38 minutes to go ahead of the closing bell. Stocks are in the green, but we are off session highs. Let's head right over to the first word breaking news desk for today's afternoon call. And here he is, Bill Maloney.
And good afternoon, Charlie. Like you said, stocks still trading in the green, but off those intraday highs, with the Dow currently up 133 points. S&P's gained 27, and NASDAQ is higher by 123. The U.S. 10 yield at 3.5%. Gold is higher by 3. Oil is in the red, but Bitcoin is climbing by 2.6%. Among the main 11 S&P sectors, leaders were tech and consumer discretionary. Energy was under pressure, and leaders to the upside in the Dow, Nike and Boeing, while Goldman Sachs fell 1% and led to the downside. In deal news, the FTC sued Microsoft to block the Activision purchase.
And we do have Microsoft shares. They are trading a little changed right now. On the other hand, we've got Activision shares on the minus side. Activision down 1.4%. Microsoft right now up by 1.3%. So let's again recap Bill Maloney's numbers. S&P up 27, a gain there of 0.7%. Dow Industrials up 138. That is a gain of about 0.4%. While NASDAQ higher now by just about 1.4%. Update on Wall Street, off session highs. I'm Charlie Pellet. That's a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening and watching Bloomberg Business Week on this Thursday. Carol Massar along with Tim Stenovic, live in our Bloomberg Interactive Brokers studio. We are streaming on YouTube as well as on Bloomberg Quick Take.
I want to take another look at a story we just heard about. The FTC seeking to block Microsoft's $69 billion Activision deal. This is a Bloomberg exclusive that crossed just a little earlier in the afternoon by our team here, that the FTC is seeking to block the $69 billion acquisition, saying that the tie-up between the Xbox maker and popular gaming publisher would harm competition. We're seeing shares of Activision Blizzard right now down by 1.3%.
1.3%, definitely off their lows. We did see a little bit of a spike down, I think, initially on this news, so they're off those lows, but nonetheless, still down about 1.3. We've got Microsoft up about 1.25% here, but, you know, regulators said Microsoft's ownership of Activision could curb competition in the gaming market, which is worth more than $200 billion, by limiting rivals' access to the company's biggest games. And the director of the FTC's Bureau of Competition, Holly Vidova, said, and this is a quote, Microsoft has already shown that it can and will withhold content from its gaming rivals. Today, we seek to stop Microsoft from gaining control over a leading independent game studio and using it to harm competition in multiple dynamic and fast-growing gaming markets.
Very briefly, Microsoft responding, saying, quote, we continue to believe that this deal will expand competition and create more opportunities, Carol, for gamers and game developers. That coming from Microsoft President Brad Smith.
Yeah, this is interesting. The proposed Activision Blizzard acquisition by Microsoft is the company's largest ever and one of the 30 biggest deals of all time. It would give Microsoft, the maker of Xbox consoles, some of the most popular video game franchises. So we're talking about Call of Duty, World of Warcraft. The Xbox maker already owns the Halo franchise and Minecraft virtual world building games. So they have some really known games, I should say, out there.
All right, let's switch gears a little bit and talk more about the debt markets and what's going on when it comes to a big story in Carvana. A lot of airtime and chat in the business world in the last week or so has been about Carvana as bondholders prepare to negotiate with the car seller to fix its debt load. They're using a playbook that could become increasingly common, Carol, when companies fall into distress.
This is why we are really paying attention to this story. Let's get more with Eliza Ronalds-Hannon. She's Bloomberg News high yield and distressed credit reporter. She's in our Atlanta bureau. Eliza, good to have you here with Tim and myself. First of all, tell us a little bit about the playbook that Carvana is following or will maybe follow, and then what it could mean for others.
Well, what we were actually anticipating is the playbook of the creditors. So even as the last few years have really seen a trend of creditors pitting themselves against each other so that one subgroup can make a sweetheart deal with the company, this represents instead the creditors banding together so that the company can make no such sweetheart deal with anyone.
So no side deals, essentially, right?
Right.
It's one, we're all in it together.
What does it tell you about the health of Carvana that the creditors have this type of power or are making a move like this?
It's really interesting because on one hand, it might signal that these type of creditors, which are, heavyweights in this type of sector and these type of restructurings, are sick of the drama that comes with these creditor violence scenarios. And they might also be anticipating that with a wave of restructurings coming, it won't be practical to get into such complex transactions on all of them. They instead need to unite and just pursue a more orderly process.
It seems to be not only orderly, but it also seems like it makes sense. Like, hey, company, you got into trouble. Why should you have maybe an upper hand in figuring out this debt situation? Is this maybe a game changer in terms of a precedent for other companies that get into similar problems like Carvana got into?
It might be, because some companies that have restructured recently have really relied on this, the type of transaction that requires either a third party or an existing creditor to issue new debt that steps on top of the existing. So it's basically a more advantageous process to the company. If the creditors are no longer willing to do that, it might make restructuring a little bit more difficult.
So does it make it easier for these companies to band together, these debt holders led by Apollo and PIMCO? Does it make it easy for them to band together because there's just a handful of them rather than, a ton of companies that have actually taken on this company's debt?
Absolutely. One of the things that made this group so strong and so come together so quickly is that most of the debt is held by just a few funds, including Apollo, PIMCO, BlackRock. If you'll recall, when Carvana issued new debt earlier this year, Apollo swept in and bought most of it when the issuance struggled. So Apollo has a huge stake in Carvana, and when there are people with huge stakes, they make things happen faster.
I love what you talked about, too, that in the era of easy money, you had investors kind of snapping up any kind of debt with any kind of yield, right? Everybody was in search of yield, and as a result, maybe they didn't pay such close attention to some of the contracts that they were agreeing to and the covenants that were in those investor contracts that maybe were more in the company favor versus the investor favor.
Yes, the covenants that are in debt issued over the past few years are practically non-existent. They really give the company the ability to strip the existing collateral away from existing creditors and use it to pledge against new debt, which is, of course, sort of devastating to the existing creditors. So that's been happening left and right.
So what does this mean for maybe some of Carvana's other assets, right? They've got real estate and other things. Does this mean that that's separate from any of these negotiations?
No, that's very much involved because that's the value that Carvana really has to offer at this point. That's their only asset. It's a tech, startup in a way. It doesn't turn a profit, but it has this real estate that has inherent value, and the creditors and the company too are assuredly at this point relying on that to be, the leverage or the asset that they use to justify a restructuring.
Eliza, I talked about this as a stock yesterday in my decliners. It's just remarkable to see the way that this company has lost value. And I know that you
It's one of my gainers today.
It is one of your gainers, but it's coming from a place of just massive value decline. Eliza, you mentioned 98% down from its all-time high. I mean, this is a company that had a market cap of more than $60 billion just last year. Given your experience covering this type of story, what can equity investors expect in terms of what this company does? Are we talking bankruptcy here?
We are, if not bankruptcy, a reorganization that happens outside of court will likely wipe out the equity value based on previous precedent. So, like I said, the hard assets at the company are only worth, $1 or $2 billion. There's a lot more debt out there that needs to be satisfied, and so those debt holders are going to take a haircut probably, receive less than 100 cents on the dollar on their debt.
Right.
And when that's the case, sort of as a rule, equity holders don't get anything back.
Yeah, exactly. They're in a really tough spot. Eliza, we're going to leave it there. Eliza Ronalds-Hannon, high yield and distressed credit reporter at Bloomberg News in our Atlanta bureau. Shares of Carvana, yep, they are rallying, so they're up Let's see, they're about $5.09. They're up 33%. Good for a gain of $1.26. But I got to say, as you said, the stock's down almost 98% so far this year, and about 43% of the float is shorted. So you do wonder, as the stock started to pop today, how much of short covering potentially is going on as well.
Its market cap is shy of $1 billion right now, Carol, coming in at $912 million, down from more than $60 billion a little over a year ago.
But it is interesting, buddy, about that whole era of in a zero return environment for so long. Investors were so eager to, get any kind of yield that we're willing to sign on the bottom line, if you will, and snap up debt. And now that things are not the same environment, that they're realizing kind of what their leverage is or lack there is when it comes to company negotiations and, refinancing or rethinking, restructuring that debt.
This was one of the high flyers of the last year. I mean, people were piling into it.
Yeah, exactly. But, it was a great pandemic play. I mean, it was 160% higher in 2020, 181% higher in 2019, up 71% in 2018. So it's been on a tear in a big way, but a very different environment. And you do wonder, is it the business model? Is it post-pandemic? Again, a lot going into this.
It's a good gainer for you today, so we'll look forward to that one. In the meantime, let's get to world and national news. We got Nancy Lyons standing by in our 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. Pro basketball star Brittany Griner is heading back to the U.S. after being released from a Russian prison. For 10 months on drug offenses, she was freed in a prisoner swap for Russian arms dealer Victor Bout. Bloomberg Washington correspondent Anne-Marie Hordern says this is a victory for the Biden administration.
She's been in Russian custody since February when she was arrested on charges because she had vape cartridges with less than a gram of cannabis oil. And then in November, most recently, she was sent to a penal colony outside Moscow. There's been a ton of pressure on the White House to bring Brittany Griner home. There's been lots of reports over the summer leading up to this.
Bloomberg's Anne-Marie Hordern says the Biden administration is catching some heat, though, for not including imprisoned American Paul Whelan in the swap, but officials say it was either just Griner or no one. President Biden says he will quickly sign legislation that was passed today by the House that requires all states to recognize same-sex and interracial marriages. The bill received bipartisan approval with a vote of 258 to 169. The Respect for Marriage Act will repeal the Defense of Marriage Act, which defined marriage under U.S. laws between a man and a woman. Democrats may have done better than expected in the midterms, but that does not seem to be helping President Biden's approval rating.
The latest Associated Press NORC Center poll gives President Biden a 43% job approval rating. 55% of Americans in this survey disapproved. Now, that's about the same as the month before the November election. Only about a quarter of respondents say the country's headed in the right direction. Democrats are showing renewed faith in the president. 77% of them now say they approve his performance. Only 10% of Republicans say the same. In Washington, I'm Nathan Hager, Bloomberg Radio.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got 19 minutes to go ahead of the closing bell. The Dow, the S&P, NASDAQ 100 index, they are all pushing higher. The key takeaway, we are well off session highs. Stocks climbed after a 5-day slide, with the S&P now up by 24 points, up by about 0.6%. The Dow up 116, up 0.4. NASDAQ now up 117. That is a gain of 1.1%. Traders are awaiting key inflation numbers out tomorrow morning for clues as to whether Fed officials will be able to notch down their aggressive tightening campaign. As for the interest rate backdrop, Kelsey Barrow is fixed income portfolio manager at JP Morgan Investment Management.
We may have run a little bit too far as it relates to this rally in yields, but I don't want to lose sight of the big picture. We do believe that bonds are back, and for the first time in a decade, you're getting income and diversification from your fixed income portfolio. If you remember back, not that long ago, 30% of the global ag had negative yields. Now only less than 3% has.
10-year yielding 3.48%, with the 2-year 4.31%. Spot gold up 0.1%, $17.88 the ounce. West Texas Intermediate crude down 0.9%, $71.40 a barrel. Speaking of crude, the Keystone Oil Pipeline System, a major conduit linking Canada to the Gulf Coast, has been shut down after crude leaked into a creek in Kansas. Pipeline owner TC Energy said the incident occurred about 20 miles south of Steel City, Nebraska. Shares of TC Energy, today they are trading up by 0.4%. And Keurig Dr. Pepper is investing $863 million in Nutrabolt, the maker of C4 and Extend energy drinks. Shares of Keurig Dr. Pepper up 0.8%. And that is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, just about 17 minutes left in today's trading session, getting ready to count down the Thursday trade. Equities, as you heard from Charlie, certainly kicking around, if you will. But we are definitely off our worst levels of the session, but we're off our highs. But it's really about the tech trade today. Those big name FANG stocks, many of them are really outperforming today.
Let's get into it with Samir Samana, Senior Global Market Strategist at the Wells Fargo Investment Institute. Samir joining us this afternoon via Zoom from Charlotte, North Carolina. Samir, it's good to have you back with us. How are you?
I'm good. Thanks for having me.
Well, thanks so much for joining us. So how do you take into account everything that we've seen over the last week or so after we heard from Fed Chair Jay Powell, got a slew of economic data last week? Mike McKee described this week's economic data as a bit boring, but we can debate that. And what we have next week coming from Fed Chair Jay Powell, how is it all laying out for you?
It just still seems a little too Pavlovian. I mean, the market just keeps dusting off the old playbook where it goes right back to, you guys mentioned FANG, non-earning, small cap growth stocks, crypto's having a pretty good day. We just think the regime has changed. Again, it doesn't have to be a major change, but, we do think going forward, cyclicals will do much better. Honestly, we're a little surprised to see oil falling, even on the day when it seems like there's some supply disruptions, and we continue to like that sector quite a bit. So there are pockets of value that, investors can take advantage of to play kind of the environment we see over the next year, but we don't think it's going to be led by those growth stocks.
Interesting. Having said that, Apple, Microsoft, Amazon, Meta are all some of your outperformers in today's session. Meta alone, and I know it's been beaten down, but it's up 30% from early November. You've got Amazon up about 15% since early November. Microsoft's up 15% since early November. And these are obviously why you're seeing certainly the NASDAQ 100 outperform today. These names or areas that you would bet on? It sounds like no when you say that you're not really into growth.
So we like technology. So if you know, too often it seems like information technology, consumer discretionary, and comm services kind of get lumped together in what I will call the growth trade. We like information technology. We like comm services. Well, parts of comm services. We're neutral there. And the part that we would probably avoid is consumer discretionary, right? That's where you've got a large electronic vehicle maker and you've got a large e-commerce company, which, you know, aren't as consumer centric as they used to be. Now they're more part of this growth trade. And I think the growth trade as a whole, you know, starts to bifurcate into the more enterprise, you know, specific names, kind of on the technology side, the true technology side, whereas the consumer probably struggles in the first part of next year as a moderate recession takes hold. Again, keep in mind that in order to get inflation under control, the Fed probably has to make sure that the consumer doesn't feel all that great in the first part of next year.
Let's talk a little more about that. What do you mean the consumer struggles just a little bit? What data is pointing to that for you?
Sure. So we talked about continuing claims earlier on Bloomberg TV with respect to how those are starting to kind of perk up and get close to levels where they're higher than they were about a year ago. If you look at the Challenger layoffs on your Bloomberg terminal, those are up, I believe, 400+% over the past year, which tells me that those should eventually start to flow into the claims data. If you look at LEI, that's down quite a bit, consistent with a recession starting in the coming quarters. So all these different things tell us that, you know, again, it's more timing of when, not if there's a recession.
One thing I want to ask you about in the notes that you shared with our producer Paul and then obviously with us is your overlying thinking is it's not a time to broadly buy equity, so not necessarily buy the equity markets. And you point to the SPX resistance, S&P 500 at the 200-day moving average in 40.45, and more resistance at the trend line off the January record high in the 41.30, 41.40 area, and not likely to sustainably break. Having said that, we kicked off our broadcast at 2 p.m. Wall Street time with Abigail Doolittle, who follows the markets for us, and she noted the Dow outperformance this year and it being above its 200-day and above its August high, and that it's hard not to make the argument that the S&P is likely to follow. Do you not buy into that?
Well, I think the tricky part there is if you look at what's driving the Dow, really, it's energy, it's healthcare to a certain extent, and then it's some of those tech names that we mentioned. And again, that to us is a pretty defensive playbook for the type of slowdown that we see. So the reason we like those three sectors is we think they'll be durable in the midst of a recession. So in some ways, it's possible that the S&P follows the Dow higher, but I would think the next move probably for both of them is probably to the downside again, because I don't think markets, equity markets more broadly, reflect a recession. You know, we were talking earlier on Bloomberg TV about how the markets, for the most part, you know, seem to be thinking a soft landing is about the really only option every time the Fed kind of talks about, you know, interest rates and the various outcomes. But, you know, Jay Powell and others have been very clear that it's still possible that, you know, a recession is possible next year, and we think it's actually pretty likely.
What do you need to see on the S&P 500 for you to say, okay, now the S&P 500 is broadly reflecting a recession?
Sure. So we've been saying price or time. So either, you know, get us to probably the first or second quarter of next year, because again, you know, if the market is a leading indicator by about a quarter or two, and we think the recession's over by, let's call it late summer of next year, then, you know, again, probably first or second quarter from a timing standpoint makes a lot of sense to us. Or the other option would be, you know, if you get back kind of to these recent lows that we've been at, call it 35, 36, 3,700. At those levels, we do think there's probably some good risk reward. And what I mean by that is, so our year-end target for next year on the S&P is about 4,400. And so, you know, at those 3,700 lows, you know, and below, you've got almost 25% upside to the year-end target range that we have for next year. And it wouldn't surprise me if there's only about 5 to 10% downside from those levels in terms of an overshoot. So to have kind of 2 to 3 to 1 odds as an investor, we think is a pretty good outcome.
All right, we're going to leave it there. Hey, Samir, thank you so much. Really appreciate your time today. Samir Samana, Senior Global Market Strategist over at Wells Fargo Investment Institute. That's a subsidiary of Wells Fargo Bank, which really kind of serves the Wells Fargo Wealth and Investment Management clients, joining us via Zoom in Charlotte, North Carolina. We've just got a few minutes left in today's trading session.
Yeah, let's take a look at how stocks are doing this afternoon. We're going to try to see the S&P 500 rise for the first time in terms of trading days in December. It's up 0.5 percentage point point right now with about 10 minutes to go until the close. The Dow up 0.3%. The NASDAQ, Carol, up close to 0.9%.
Yeah, well off our lows of this session, but again off our highs. We saw some stronger gains, certainly on that tech trade in the NASDAQ earlier on, but a little bit off of those highs. And if I take a look quick at the 10-year note, we've got a yield of 3.47, 2-year note, that's shorter end 4.3, but those yields still staying lower. We're going to check in with our TV colleagues. We're going to talk about the markets, count you down to the close on this Thursday.
It is 3:53 on Wall Street. I'm Charlie Pellet with a look at some of today's company headlines. Federal Trade Commission is seeking to block Microsoft from acquiring Activision Blizzard, alleging that it would, quote, enable Microsoft to suppress competitors to its Xbox gaming consoles and its rapidly growing subscription content and cloud gaming business. We've got Microsoft shares up by 1% ahead of the close, while Activision is down by 1.4%. ExxonMobil has raised its annual share buyback by about 10%, 6 weeks after the oil giant posted its highest profit in its 152-year history. ExxonMobil shares are up now by roughly 0.3%. Airbnb is blocking some users from booking single-night rentals of entire properties as part of its home-sharing platform's push to prevent parties on New Year's Eve. The company will ban the reservations for guests without a positive account history or previous bookings on the platform, factors that it sees as likely for a party to occur. Airline stocks, for the most part, are moving higher today. Airfares will increase around the world next year by as much as 12% on Europe-Asia routes and around 10% for North America-Asia flights. This according to American Express Global Business Travel. Among some of the U.S. carriers that fly overseas, UAL down now by 2.8%. American, little changed, up by about 0.1%. Delta down 2.5%. And right now we have got JetBlue down 2.9%. Those are some of the top stories that we're following. I'm Charlie Pellet. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
You are listening and watching Bloomberg Business Week on this Thursday. Carol Masser along with Tim Stenovic here in our Bloomberg Interactive Broker studio. So we're going to catch up with our TV colleagues in just a moment, talk about the trade. Charlie, of course, just giving us the rundown, so we'll dig a little bit deeper. We also have a slew of earnings coming after the closing bell. Lululemon, DocuSign, RH, Broadcom, and Costco. And so we'll be breaking them down, looking for some indication of what CEOs have to say about consumers, about the outlook, what's going on.
Which one of those do you think gives the best outlook for a consumer?
Probably Costco.
I was thinking that too. I mean, Lulu's certainly a one demographic, one slice of demographics. It's really high end.
Yeah.
But I think, and Costco also serves the higher end, but it'll still give us a good idea of what people are thinking about the economy. Are we going to get any commentary from Costco about people trading down? Can you actually do that at Costco?
I don't know, but I think it's a good indication because they tend to weather, it feels like, a lot. Lululemon, you get, as you said, a little bit higher end. DocuSign, it's been an incredible pandemic play. They've got a new CEO, so what's life like after? And then, of course, Broadcom, always good when you get some insight into the tech sector in particular. And so we'll see what those companies have to say. In the meantime, one thing we just want to mention, just kind of something as an aside, Manhattan apartment rents, they seem to finally be inching up after 3 months of decline. So sorry about that, who are hoping to maybe talk to the landlord and say, hey, listen, rents are coming down.
Okay, well, they're not going to go back to the hyper-competitive heights of the summer. Remember when you saw those TikToks, Carol, or those videos of the lines out, stretching all the way down a walk-up and outside for people to actually look at an apartment?
Right.
The median rent rose 2.1% from October to $4,095. That's the third highest level ever recorded by the appraiser Miller Samuel Lincoln, brokerage Douglas Elliman Real Estate. Yes, there were also indications that demand wasn't particularly strong, including a rising share of new leases signed with concessions and a higher vacancy rate.
Yeah, and this is like we are watching the housing market so carefully, and you do wonder, are rents going up because, again, people can't find homes and, kind of what's going on here. So some of these metrics, housing, what it costs, whether it's, mortgages, rents, these tend to be sticky. And these have certainly played into the inflationary pressures that we have been seeing and something that the Fed is trying to combat. All right, folks, we're going to head over to our TV colleagues in just a moment, talk about the market trade. We've got just about 2.5 minutes left. And right now you've got the NASDAQ, a 1% gain, bouncing around, Dow up about 0.5%, S&P a gain of 0.7. Beyond the Bell, coming up on radio, TV, YouTube, and Quick Take.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld. We're counting you down to the closing bell. We're here to help take us beyond the bell. A global simulcast with Carol Masser and Tim Stenovic. Welcome to our audiences across Bloomberg Television, Bloomberg Radio, Quick Take, as well as on YouTube. Carol, make some sense here of the price action coming off the 5 days of declines, and looks like people want to buy again.
I feel like we're bouncing around. Just look at the last hour, the kind of the ups and downs that we've seen in the major equity averages. I was just updating on my Bloomberg some of the big FANG names because they have definitely been outperforming in today's session. You've got Apple up about 1.2%. You've got Microsoft up 1.2%. You've got Amazon up more than 2%. Meta is up 1.2%. Do you know Meta is up about 30% since early November? So it's interesting when people kind of push back on some of those great growth names and FANG names. That's what we're seeing outperform today.
Well, speaking of pushing back on those growth and FANG names, Samir Samana just joined us, Senior Global Market Strategist at the Wells Fargo Investment Institute. I know he was on your program a little earlier as well. He says that he doesn't think equity markets right now broadly reflect a recession, and we could see retesting lows of 3,700 and actually below, because that would again give us, in the early part of next year, 25% upside to what his target range is for next year, which is at the end of the year, 4,400. And he's saying, he doesn't think that tech is the leader in this next round. The regime has changed.
What is the leader?
Cyclicals, he said, are going to do much better. He was surprised to see the move in oil today, given the supply
I don't know
constraints.
about you guys, but tech is a big part of my life.
Is it? Well, thank you, Carol.
She texts me a lot. Yeah.
All right, let's walk you through here the closing bells real quickly. Here, Dow Jones Industrial Average higher by about 0.5%. S&P up about 0.8%. The Nasdaq higher by more than 1% here on the day, and the Russell 2000 up by about 0.6%. Now, whether this mini rally that we had today, Carol, is a result of that softer weekly jobs report, jobless claims report, I should say, remains to be seen. Of course, we get two other big data points: PPI tomorrow, and of course CPI next week ahead of the Fed meeting.
Yeah, absolutely. They will be key, and obviously that Fed meeting will be key. S&P 500, let's just go there. Broader market, like to look at that. Most names in the index actually higher today, Katie, at 353 to be exact, 148 losing some ground, 2 unchanged. You're going to dig a little bit deeper, though, into what exactly was moving here.
Yeah, it was pretty uninspired. I mean, if you look at the industry groups, you do have more green than you do red. Up at the top, you had nice rally in the chips. That industry grew up more than 3% or so. I see some durables up there as well, some consumer services as well. You look down at the bottom, it's telecom and it's energy, which is interesting. Energy having a really tough go of it lately, Carol, not joining in on this rally.
All right, so let's get to some of the individual names that actually saw some outperformance in today's session. Carvana, we've been talking about it, right, a lot for the last week or so, and that stock was up about 30% in today's session. It sunk a record 43% yesterday, so a little bit of a bounce back, if you will, today. Narrative today also was more upbeat, and that's why you saw investors potentially moving into it. The company consulting with lawyers and investment bankers about options for managing that debt load. I know we've all been talking about it on Bloomberg Properties as plunging used car prices and the company's swift cash burn, we know, have really threatened the future solvency, but maybe they're all bonding together, if you will, and trying to figure out a solution going forward. Also want to point out Datadog, top of the NASDAQ 100. This one was good for about an 8.5% gain. The company's board member, Matthew Jacobson, bought $13.3 million of shares. That's according to a filing with the SEC. So we saw that in terms of some outperformance. And I do want to go to Rent the Runway. I know it's a really super small cap, 142 million, but that stock was up about 74% in today's session. Hard to ignore. It's still, though, down more than 70% year to date. About 13% of the float is shorted, so maybe some short covering going on. But last night, it did report stronger than expected quarterly results, boosted the company's annual revenue outlook. Wells Fargo coming out and saying third quarter, a welcome sigh of relief following last quarter's volatility. Wells is overweight, though, on that stock. Again, up 74% in today's session, Tim.
All right, let's check out some of the decliners here, starting with Tesla. It was a choppy session. It moved between gains and losses today 8 or 9 times, but it did end up finishing the day down by 0.3%. A lot of news for Tesla investors to digest. Starting with early this morning, Bloomberg News reported that Tesla is going to shorten production shifts at its Shanghai factory as soon as Monday. It adds to signs for the demand electric car in China is not necessarily meeting expectations. Also, Elon Musk bankers considering some of the high-interest debt he layered on Twitter with new margin loans backed by Tesla. And then Sean O'Kane has a really interesting story out today about how one of Tesla's largest individual shareholders said that the Tesla board, with all of this tension happening, all the challenges that Musk is facing, they are, quote, missing in action. Definitely check that one out on the Bloomberg terminal. Activision Blizzard down 1.5%. This after Bloomberg reported that the US FTC is seeking to block Microsoft's $69 billion acquisition of the company, saying that the tie-up would harm competition. It was down as much as 3.7%, but did finish off its lows. We should note that Microsoft's president, Brad Smith, said that, quote, we continue to believe that this deal will expand competition and create more opportunities for gamers and game developers. And then just want to finish with the among the worst performers on a percentage basis, the Lincoln National down 10.8% today. It's worst in more than a month. The company's CEO came out at a conference hosted by Goldman Sachs and says that she expects distributable earnings to be between $650 $600 million and $800 million next year. Investors reacting negatively to that news.
All right, we go back here to the broader market here and the flip-flop that we continue to see in Treasury positioning. That continued here on this day. Remember, we were bearish on Monday, bullish on Tuesday and Wednesday, and now back to bearish here. You see where yields have actually drifted a little bit higher here, but really the net effect is kind of hunch so far on the week. I think something like 4 basis points on the 2-year from where we were on Friday here, and the inversion across the curves, that's still just about as deep as it's been in a generation. The 2-10s curve still at about negative 83 or so.
I have to say, when I was watching all the market volatility on the equity side of things, Romaine, I went back to the Treasury trade and just looking at how yields have kind of settled down, particularly at the longer end, and just the expectations going out. And this is where I do wonder, Katie, what we get from the Fed next week, what kind of view that they have longer term when it comes to rates. I know they expect inflationary expectations to come down to more historical levels, but I'm just curious to see how much they stick to that.
And what they have to say about the potential for a recession that we've been hearing about ad nauseum all week. Is this a recession trade that's going on at the long end of the curve? Because the rally that we've seen there has just been astounding.
But to your point too, Carol, I mean, I know PPI, a lot of people kind of poo-poo it here, but we talk about just how far it's come down. I mean, we peaked, at least on the headline number, I think, in March? And it's pretty much been a straight line down. I mean, every single month it continues to go down, and I think the estimates for tomorrow are the same, whether you're looking at the headline number or the core number here. And I know that's not the main metric the Fed looks at, but there is a lot of evidence here that inflation fight, it's worked.
It's a trend line, right, that's moving in the right direction where the Fed wants it to go. All right, we got earnings, right?
We do have some earnings. Lululemon is out. Full year net revenue seen at $7.94 billion to $7.99 billion. The company had been expected about $7.87 billion to $7.94 billion. You look at how the stock is reacting, not happy, down 11% or so post-market as investors sort of digest that.
Down 11% here. To the upside, though, is DocuSign up about 13% here in after-hours trading. Those earnings crossing the wire right now, 57 cents on the 3Q adjusted numbers. That's a beat over the 42 cents estimate here. Subscription revenue at $624 million. That's also a beat. Here's our guidance. Full-year revenue, 2.49 to 2.5. We'll just call it 2.5 billion. That's above what the street was looking for. Similar story for some of their guidance when it comes to some of the quarterly figures as well. So overall, it looks like at least the knee-jerk reaction here on DocuSign is positive.
Not getting some great insight into the company, looking through the press release as far as commentary coming from the company's new CEO, who says, quote, "We delivered solid third quarter results, are pleased with the continued progress against our critical priorities. He looks forward to continuing to advance our business as we both innovate and operate at scale to deliver value for all of our stakeholders." As a reminder, it did really well during the pandemic, but questions about the way that people will continue to use it weighing on investors.
But are people stopping using that? I mean, this whole argument that
I agree with you.
Are we going to go back to this?
What are you going to go find your notary and we'll meet up in person to sign something? You can do this on your phone. I just signed one on my phone. It's
like we're in ancient Greece or something.
I'm doing it right now. Just kidding.
Don't you want to be a notary? You always want to have that stamp. Hey, listen, I'm looking through the...
You know how easy it is to be a notary?
Yeah.
Sorry, I just offend
just saying the notaries that are out
I have notaries in my family, so I know the process.
I'm looking through the Lulu press release here, and what's interesting is they talked about we are pleased with our early holiday season performance. Look forward to all that's ahead for Lululemon as we continue to deliver on their plan. But I do want to say that something the Lululemon CFO said: we are proud to have delivered another quarter of strong sales and earnings growth despite an operating environment that remains dynamic. What do you read? Dynamic. That means changing. We're not quite sure. Lots of things going on.
And you look at what happened to their gross margin. It actually misestimates a little bit, 55.9%. The expectation had been for 56.7%. So a little bit of a disappointment on the margin. Maybe that's what's filtering through to the stock, because again, another big move. And this stock had only been down about 4% year to date. Lululemon has been very resilient, so the bar was high.
Very resilient. Just real quickly, Chewy crossing the wire. Those numbers also beating as well, beating by a lot. Pets are resilient, or at least the money we spend on pets. Have to spend on pets.
We spend a lot.
Are you a
on
pet
pets.
person?
Me, I have 2 dogs at home.
Okay.
Are you kidding?
And Katie's got like a few horses. Tim hates animals, right?
No, I don't. I love cats.
Tim, I can't even get him to buy a stuffed animal upstairs from the Wildlife Federation.
That's for charity.
Hey, Chewy, by the way, is up 5.5%.
I bought 2.
DocuSign is up 14%. Lululemon is a bit of a bummer. It's down about 11% in the after hours. So we'll watch them into the Friday trade.
All right,
That's
bye.
a wrap. Bye. Beyond the Bell, our cross-platform coverage, radio, TV, YouTube, and on Bloomberg Quick Take. We will see you again, same time, same place, tomorrow.
This is Bloomberg Business Week. with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, you are listening and watching Bloomberg Business Week on this Thursday. Carol Masser along with Tim Stenovic here in our Bloomberg Interactive Broker Studio. Well, a recent Bloomberg opinion piece noted there's no question that plant-based product sales in the U.S. have been flagging. The category's meteoric growth in 2020, flattening in 21, and since last September, a key portion of its retail sales has dropped more than 10%. But this column, Tim said, still it's a mistake for investors to write off the value and potential of the sector as a whole, which will be a keystone among climate solutions going forward. That was the backdrop for a discussion I had yesterday at the Bloomberg Live Sustainable Business Summit in New York City.
You caught up with Impossible Foods CEO Peter McGinnis. You kicked off the conversation talking all about what seemed to be a, quote, plateau when it comes to the plant-based food industry. Check it out.
It's a very dynamic category industry with huge potential. And it's in its infancy, and I think hopefully we'll talk about that today. A lot of people say, oh, the plant-based category, is it declining? Is the demise of it? It makes a great headline. It's a sensational story. And I would just say that it hasn't been established and created yet. So a big part of what I want to do at Impossible Foods is...
What do you mean by that? Because it has been established.
No, it's been around in earnest for, probably less than 5 years.
Okay.
There's been vegan burgers and things out for 10 or 12 years, but in terms of all protein that's going, trying to displace the animal product, that's a 3 to 5 year phenomenon. And we just launched in retail 2 years ago in the middle of COVID. So if you discount, we've probably been available at retail for a year.
Yeah.
And so I think it's in its infancy. And I think it's yet to be created, yet to be established. And I think it's our job to really create this category. It's a $3 billion category in a $1.4 trillion addressable market. So it is very, very small, right? And it's our job to mold it and shape it and grow it. And that work hasn't been done yet.
Peter, you're someone who knows the food industry really well. You and I were just you were reminding me you were 10 years at Chobani and you're doing this. You understand kind of reaching consumers and what they want. I want to go to a recent Bloomberg opinion piece that talked about plant-based product sales in the U.S. and they said they've been flagging.
Sure.
The category's meteoric growth in 2020, flattening in 2021, and since last September, a key portion of its retail sales has dropped more than 10%. Its reputation has also been badly bruised by the stock performance of Beyond Meat, which is down more than 90% from a peak back in 2019. The column does go on to say, still, it's a mistake for investors to write off the value and potential of the sector as a whole, which will be a keystone among climate solutions going forward. So first up, I'm going to get to the climate solutions in a moment. The first part, though, unpack it for me. What is, though, wrong with plant-based industry today and the sales? And then we can get into kind of the...
So the category is down, and that is a fact, right? You can read IRI data, Nielsen data. It was plus 40, 50, 60%. Now it's hovering at -5 to -7, depending on the week. And there's a lot of reasons for that. There was a COVID bump probably in there somewhere along the lines. Yeah. There was a novelty bump when it really, first became available. So some of it's a correction, some of it's some noise in the data, and then some of it there are players in the category who will remain nameless because I'm a proponent of the category that are not doing well.
Okay.
And so, the category is a composition of companies.
Right.
And so if there's some companies in a category that don't do well, they can bring the whole category down. And so we're doing well. I mean, we're growing 60% at retail. We're in 40,000.
Top line?
Top line
Yeah.
sales. And so we have our own playbook and we have our own, approach here. But I think it's lazy to look at comparables and try to project that on a category. Right? Each company has their own issues and challenges and playbook, and some work, some don't work, but that doesn't mean that you should cloud the whole category, right? And I think the category also is confusing because some of the players in the category are old vegan burgers that are veggie burgers, and some of them are all meat, which I don't like the name of that, but those are those products that are displacing
faux meat, never good.
Never good.
Do you want to eat faux meat? No.
Never good. And then look, I think the animal industry's done quite a good job. They're highly coordinated and pretty loud in trying to confuse this plant-based meat category.
Right.
With calling it processed or faux or too many ingredients. And they have a lot of money. and they're highly coordinated, like I said. And I think where the mistake of the plant-based meat is, it's young, it's restless, it's very fragmented with a lot of different players. And we have not been coordinated in our messaging, and we have not been loud in support of our products. And so combination of big meat kind of being loud and coordinated, and plant-based meat being shy and uncoordinated has not helped the situation.
So let's talk messaging. And let's get to the second part of that Bloomberg opinion column, which said, it's a mistake for investors to write off the value and potential of the sector as a whole, which will be a keystone among climate solutions going forward. Climate solutions going forward. So why is plant-based food a keystone among future climate solutions?
Yeah, it is the scale of food.
Because this would be great for the narrative.
Yes, it would be great for the narrative.
Or the reality.
And it's a complicated message to get out there from a consumer perspective. And I think a lot of the issue around, look, the food has now come a long way. So the food now stands up against the animal product. And most people that try it say it's much better than I thought, and taste, texture, flavor. And especially when you build a burger and you have cheese and, you know, put lettuce and tomato on it, it's very difficult, right? And we hear that with Whoppers, and we hear that with our Impossible Sausage Sandwich at Starbucks. So the food is in a really good place. We have not got the health credentials across, right? It's zero cholesterol meat, right? That has 30% less saturated fat and less calories. That has not been communicated. And then the climate piece of it, there is no other alternative to reverse climate change other than food. So most people equate climate change with electric cars, recycling, less electricity, less water use. Those are all good things. They will not reverse climate.
Food
Scale of them.
Food systems account for a third of emissions.
A third of emissions. Also, if you think about 50% of the usable Earth's land mass is animal agriculture related, and all of that land has been cleared. 50%. 3% are towns and cities. 50% of the entire Earth's worth. So the scale is huge. And as a result, 60% of all wild animals have been killed. And animal products, and I don't want to sit here and go on and on about how bad the animal industry is.
We'll talk about your climate imprint when you guys do
So our plant-based meat, if you look at 50 million pounds of our plant-based meat versus 50 million pounds of animal meat, right? Direct comparison. We'll use 4.5 billion less gallons of water. We would save 37 million trees, and we would avoid 1.5 billion pounds of CO2. That's 50 million pounds. That's a small amount, right? That's a fraction of what we will make this year. So the scale is massive, right, when it comes to food. So food choice and climate change is a very, very powerful thing. It's misunderstood. Many people are not aware of it, right? They just don't equate food choice with climate change. So the more we can educate people, I think it can be quite powerful. And there is no other tool out there that has the power to reverse climate change like food choice.
All right, that, of course, was Peter McGinnis. He is the CEO of Impossible Foods. He was speaking at the Bloomberg Live Sustainability Business Summit in New York City that was held this week. If you missed that conversation, go to BloombergLive.com to hear more. But plant-based food, I mean, it was like, you know, it's been around for 4 or 5 years, was all the rage, right? We saw growth and partnerships, and then it kind of leveled off, and they got to figure out their way forward.
I knew who he was talking about when he said, you know, one company that's in the public sector that won't be named.
Starts with
Beyond, and it rhymes
public.
with meat.
Very good point. Hey, we've got some earnings coming out in the after hours, Broadcom and a few others. We'll break them down in just a moment right here on Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Stocks higher after a 5-day slide. Lots of earnings after the bell. We begin there. Lululemon out with results that beat analyst estimates. It is also boosting its full-year outlook, but shares are lower as a gauge of profitability came in less than expected. Shares after hours down by about 7%. Costco's earnings are out. Costco reported EPS for the first quarter that missed the average analyst estimate after hours. We've got Costco down now by just about 0.9%. DocuSign shares, they are up, surging 13% after the company boosted its revenue guidance for the full year. That guidance beat the average analyst estimate. Also reporting moments ago, Broadcom, it reported adjusted EPS for the fourth quarter that beat the average analyst estimate. Broadcom higher after earnings, up now by about 2%. The Dow, the S&P, and NASDAQ all moving higher today as traders await key inflation numbers out tomorrow morning. S&P up 29, up by about 0.8%. The Dow up 183, up by about 0.6%. NASDAQ up 123, up by 1.1%. 10-year yield 3.48%, with the 2-year yielding 4.30%. Gold up 0.2% today, 17.89 the ounce. West Texas Intermediate crude was down 0.5%. WTI 71.68 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much for that update. Charlie Pellet with a Bloomberg Business News Flash. So we're not quite done with 2022. We're getting close. Certainly, though, not too early to start thinking about next year, especially when it comes to disruption in tech. Check this out. Worldwide IT spending is projected to total $4.6 trillion next year. That's an increase of 5.1% from this year, according to Gartner. Demand for IT in 2023 expected to be really strong as enterprises push forward with digital business initiatives in response to economic turmoil. So we saw that right through the pandemic, and then, Tim, it's just expected to continue.
Yeah, we've got a great voice to talk about all this joining us right now. Mike Bechtel is chief futurist at the consulting and advisory firm Deloitte. He joins us via Zoom from Naperville, Illinois. Mike, good to have you with us this afternoon. I want to go to one of the numbers that Carol just shared. $4.6 trillion. It sounds like a lot of money, but that's only an increase of 5.1%. So it's not even pacing with inflation right now. Where do you think about the outlays when it comes to tech next year? Because certainly, at least Gartner expects we're going to see a little bit of pullback.
Yeah, you know, Carol and Tim, thanks for having me. I'll tell you, here at Deloitte, one of the things we've recognized over the last few years is that every company is a tech company. And the investments in tooling, in automation, in emerging tech, they're not as cyclical as the rest of the economy insofar as folks are always looking to do what they do leaner, meaner, and cleaner. And so, you know, I can't speak to other firms' projections, but we see our clients going all in on things like AI, virtual and augmented reality, and even tools like blockchain.
Well, okay, so how are they going all in? What does that mean?
Well, as a futurist, right, an admittedly curious term, I see myself as a historian. And when we look at the last 50 years of technology innovation in business, there tends to be 3 tracks that rule the day: the way we interact with machines, the way we get information out of machines, and the way we crunch the numbers under the hood. Well, metaverse, for example, virtual reality, augmented reality, this stuff isn't savior or snake oil. It's a merely very useful way to get beyond all these screens and, you know, glowing rectangles in our lives. And so companies are starting to look at virtual reality as a way to train folks more effectively, more safely, and to promote and, you know, plus their existing businesses. When it comes to AI, you know, organizations realize that automation has always been a winning strategy. We've had mechanical muscles in the forms of robots for 50 years. What we're starting to see is mechanical minds, right? The idea to automate discernment, decision-making. A large U.S. airline taking a 4-hour nightly graveyard shift job and turning it into a 2.5-minute process. Now, interestingly, the people who were doing that work, they weren't let go. They were given the opportunity to work on better gigs during the daytime dealing with higher order problems. So generally speaking, organizations sign up for automation and insights, and a lot of these emerging techs are delivering against those.
You mentioned the blockchain, and my head immediately goes to Bitcoin, crypto.
I thought you were going to say that it goes to mush because you really are like,
I'm
just being honest.
It's true because I think we've heard over the last couple of years a lot of companies adding blockchain, to their press material, saying they're experimenting with it, thinking about it as sort of a buzzword. And I wonder, how much the decline in crypto this year, the fallout from the collapse of FTX and the contagion that we see there, has executives thinking differently about this type of technology?
Tim, back to my point that futurists are secretly historians. I'm at this point in my career where I'm half geek, half geezer, right? I've got the optimism of a proper geek, but I've seen some stuff and I can separate possibility from profit. Here's what I would tell you. The whole blockchain scene reminds me of the early .com scene in the late 90s, right? As Buffett famously said, right, when the tide goes down, you see who's been swimming naked. Well, here's the punchline. A lot of the individual apps built on blockchain technology, some of them are swimming naked, right? And we're starting to see the wheat separate from the chaff. But the rails, the firmament of blockchain-based tech, that looks to be pretty enduring and pretty real. And so I think as people start to separate in their mind, cryptocurrency, digital money, from what we see more broadly is this idea of trusting in cryptography, right? And having immutable public records of what true means in a post-trust economy. We're going to see blockchain have legs in the same way that the internet ultimately had legs after the .com crash.
It's funny, Mike. I was thinking this morning when I was walking in, because we get a lot of strategists who come on and be like, you got to move away from the growth names and the FANG stocks. And
Samir Samana saying that today.
My world is my phone, right? And whether I am talking to someone, communicating work, personal, buying, finance, like there's so much stuff that you do through it. I just think of those names, how much that they, consume my life. And I'm wondering, can you paint a picture of something that is going to be as dramatic as the phone has been to our life that might take 5 years or 10 years? But, what is it? Is it the metaverse or what is it?
Well, Carol, one of the ideas that we talk about a lot in futures work and we address in our Deloitte Tech Trends 23, which just dropped yesterday, is this idea that any one of these emerging technologies, right, metaverse, blockchain, AI, if you look at them a la carte or individually, they can feel like buzzword bingo, right? Mm-hmm. But we use this term convergence. It's when all of these things are working in concert that we start to see meaningful change. And so, I think some of the, over the 5-year frame, some of the technologies we're going to really start to see making hay are artificial intelligence, turning the corner from what we think of as STEM skills, right? Like today when folks automate with AI, it's a lot of math, it's a lot of spreadsheets, a lot of clicking and clacking. But we're starting to see groups create digital creativity, right? Artificial paintings, artificial poetry, right? And so the idea that these are not robots to be feared, these are going to be the new must-have tools that designers and creatives themselves use. One of the things we've generally seen is that every time an automation has taken place, it's created better and higher order jobs for folks. I'm not trying to paint a panacea like the Jetsons, but I will tell you, it doesn't have to be as scary as the Gen X movies I grew up with.
Are you sure? And I say this because, somebody like Elon Musk for years has warned about the dangers of AI. We're kind of seeing it, we're seeing the brilliance of AI play out right now. I don't know if you've seen on Twitter lately, there's the idea of open AI is just going viral with how well it's doing when people ask it questions. Are you sure we don't have to be concerned?
Well,
deepfakes are pretty concerning.
No, deepfakes are concerning. In fact, we spoke with an organization, my team and I, just a couple days ago, that's out to defend us against just that, right? This idea of, as a Gen Xer, we used to use the term pics or it didn't happen. But what if you can't trust the pics? And so, blockchain to the rescue. Imagine a world of chain or it didn't happen. right? If you can't prove the provenance of a photo on your news site, can I trust the photo? Well, anyway, the point is this. I think, there's a Pollyanna approach that would say, oh, it's all sunshine and rainbows. There's also that sort of skeptical dark mirror approach where you say, oh, I think it's all trouble. I think we at Deloitte, our job is to give our clients an engineering advantage, right? And so we look at it as a clear mirror. We say, listen, there's pros, there's cons, every tool. And listen, I was an anthropology major 25 years ago. 10,000 years ago, what made humans humans was we figured out how to work tools. And yeah, tools have come a long way since the axe, but tools have always been double-sided, used mindfully. There's a lot of good. Used recklessly, there could be a little bad. And so to me, I think it's neither optimism nor pessimism. It's pragmatism.
It's like something we talked about yesterday, technology ransomware, that is where technology goes in the wrong direction, right? And then you've got to have a whole other group of bandits helping to counter that. Hey, Mike, we've got to run. We've run out of time, but really some interesting things to think about when it comes to technology and how it impacts our world going forward. Mike Bechtel is Chief Futurist at Deloitte, joining us via Zoom from Naperville, Illinois. How are you thinking about this, Tim?
I don't know. I mean, I'm a little concerned about AI.
Yeah, it's a little creepy, especially, all right, we're going to continue thinking about this. Right now, though, we want to think a little bit about the world of national news. Nancy Lyons is on it. She's in D.C. Hey, Nance.
Thanks, Carol. A prisoner swap between the U.S. and Russia means WNBA star Brittany Griner is heading back to the U.S. The U.S. is releasing notorious Russian arms dealer Victor Bout. In return, President Biden says he has spoken with Griner and she's safe.
This is a day we've worked toward for a long time. We never stopped pushing for her release. It took painstaking and intense negotiations, and I want to thank all the hardworking public servants across my administration who worked tirelessly to secure her release.
The president says the administration is still negotiating for the release of American Paul Whelan, who is serving 16 years in Russia on spying charges. A week after he signed a bill blocking a railroad strike over sick pay, which angered some of organized labor, President Biden brought in union leaders today and announced a bailout of a major pension fund. We get more from Bloomberg's Irv Chapman.
The money comes from the pandemic relief bill, which could potentially help 200 financially struggling union pension plans.
My administration is announcing the single largest approval of funds, $36 billion, to cover over 1,000 employers, 350,000 union workers and retirees, facing cuts up to 60% of the benefits if we hadn't acted.
The president was introduced by a grateful member of the Teamsters Union, whose Central States Pension Fund is getting the federal help. In Washington, Irv Chapman, Bloomberg Radio.
A massive defense spending bill is on its way to the Senate after passing the House. One of the more controversial provisions requires the Pentagon to get rid of the COVID vaccine mandate for members of the military. The outlook is not as rosy over the annual government spending bill. Republicans and Democrats are at an impasse with just days to go before a December 16th shutdown deadline. Lawmakers are leaving today for a long weekend. Global news 24 hours a day on air and on Bloomberg Quick Take.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Stocks higher today after a 5-day slide after the bell. Lots of earnings, and we begin with Broadcom. It's out with an upbeat sales forecast for the current period. After hours, Broadcom shares up now by roughly 3%. DocuSign surging 15% after the company boosted its revenue guidance for the full year. Lululemon is reporting results that beat analyst estimates. It's also boosting its full-year outlook, but shares are lower, down by roughly 7% as a gauge of profitability disappointed. Costco out with earnings per share for the first quarter that missed the average analyst estimate. Shares now down by about 0.9%. An update for the Dow, the S&P and NASDAQ. S&P up 29, a gain of 0.8%. The Dow up 183, up by 0.5%. NASDAQ up 123, higher by 1.1%. 10-year yield 3.48%, with the 2-year yielding 4.30%. Gold up 0.2%, 17.89 the ounce. West Texas Intermediate crude oil down 0.3%, 71.83 a barrel. So it was an update for the Dow, the S&P, and NASDAQ. As for the market outlook, Samir Samana is senior global market strategist at Wells Fargo Investment Institute, and he was interviewed right here on Bloomberg Business Week.
In some ways, it's possible that the S&P follows the Dow higher, but I would think the next move probably for both of them is probably to the downside again, because I don't think markets, equity markets more broadly, reflect a recession.
And again, the S&P higher today, up by 29 points, up 0.8%. The Dow was up 0.5. NASDAQ up 1.1%. 10-year yield 3.48%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, check this out. Roughly 40% of global greenhouse gas emissions can be traced to constructing and maintaining buildings, yet the building sector has not commanded much attention at international climate events until now. We saw something a little bit different, Tim, at COP27.
Yeah, that, of course, is the UN Climate Change Conference that was held last month in Egypt. More than 140 events there over the nearly 2-week gathering focused on real estate and construction. We've got with us Katie McGinty, Vice President and Chief Sustainability Officer at Johnson Controls. You know them. They're the company that creates air systems and those for building management, security, fire safety, and more. She was actually at COP27, along with quite a few of our colleagues, I should say, in Sharm el-Sheikh last month. She joins us via Zoom this afternoon from Milwaukee. Katie, good to have you on with us. How are you?
Terrific, and how are both of you? It's good
and
to be
excuse
here.
me, you're in Philly this afternoon, so please. I wanted to just start with what your experience was like at COP27, and if you indeed noticed a difference in the way that the organization and people who were there talked a little bit about the way that buildings are responsible for greenhouse gas emissions.
There's been a remarkable shift in climate negotiations. I've myself participated in them for almost 30 years. And the big shift really goes to the value proposition now. Businesses stepping up, one, and seeing the threat to long-term asset value in not taking action. But in the building space, it's an especially promising momentum because the digital technology that we can deploy now to dial down greenhouse gas emissions also unleashes incredible strategic potential of buildings as an asset to drive business value like we've never seen before. So the dynamic is totally different, with business really at the forefront, driving and calling for strong and determined action.
Okay, so give me an idea. You know, the stats that you've shared with us and our team, buildings account for almost 40% of global greenhouse gas emissions. How does that stack up among, because we talk about agriculture, the impact that that has, you know, waste, garbage, so cars. Is this the worst? This is the biggest?
Well, you know, when we talk about solutions to climate change or some of the things that are causing climate change, we often talk about things like solar energy and wind energy and electric vehicles, and they are absolutely a critical piece of the equation. In buildings, we have a pretty unique combination. As you were just describing, certainly is one of the biggest contributors when you take account of the materials we use to build the buildings, That's about 25% of that 70. That's about 25% of that 40%, and then 75+% is in the operation of the building. But the reason that buildings have now jumped to the forefront is because, one, we have to tackle that, but the flip side is that that's a lot of wasted energy, a lot of wasted cost. So our Open Blue digital platform, for example, say you're a hospital. Well, it's not only the temperature, the humidity sensors we use to dial down the HVAC isn't just cutting your energy bill, it's accelerating patient wellness, because those same sensors help us to cut hospital-acquired infections. Similarly, let's just say you're a commercial business. Okay, well, the same occupancy sensors that are going to help us dial down your energy bill are going to enable us to increase the health, wellness, happiness, and productivity of your employees. There's just a tremendous technology upside now to buildings when we digitalize them. Buildings are so unlike your car, which are a computer on wheels. Now, buildings are analog, they're a giant on-off switch. Bad things happen when they're off. But with digital, we can not only take account of cutting emissions, cutting costs, but unleashing the strategic potential. A building can become like a giant battery.
Katie,
optimized as a system, and then talk to the electric grid and make the building owner money when you can sell green electrons back to the grid.
Katie, when we're thinking about buildings and sustainability, and given my context is New York City, where we have, oftentimes we're living in buildings that are more than 100 years old. I'm wondering about, what role the government has and how you work with governments. Here in New York, we have these energy grades as a result of a law back in 2018. Is that something that you're increasingly seeing? And are you working with governments around the country in order to implement rules and regulations?
Yeah, so a couple of things. Let's talk about right there in New York City. It shows you the incredible money we're leaving on the table when we're not acting on buildings or deploying digital. So the Empire State Building, for example, is a longtime great partner of Johnson Controls. When we put in our very efficient operating systems, HVAC and others in the building, but then when we add our Open Blue digital platform, we literally have achieved $40 million in energy savings for that iconic building. And you're right, there's some smart policies beginning to really drive this. First of all, in the US, for example, broadly, the federal government now with the Inflation Reduction Act has put some $370 billion on the table, a major piece of which recognizes we need to upgrade buildings in this country. So there's significant money to push this and get it done. And in New York City as well, New York was a bit of a pioneer in a policy that just says, look, every X number of years, every couple of years, we're just going to drive an increase in the efficiency and performance per square foot of every building. And that's been really interesting because it's leveling the playing field so that the people who lease a building now, their interests are aligned with the developer of the building, the owner, because everybody's got to meet that performance standard. So it's bringing a lot of activity into a sector that can help heal the environment and heal your bottom line as well.
Katie, just really quickly, 25 seconds. We're running out of time. New construction, are we increasingly moving into new construction that already has all this stuff built right in? Just quickly.
We are, and there are, I call them magic machines, heat pumps. We build these heat pumps. Not only are they efficient, but for every bit of energy you put in the front end, you get 3 and 4 times the workable energy on the back end. Because we're capturing the waste heat, we're capturing the waste thermal energy, putting it back to work, and it's driving productivity, health in buildings, and it's helping to heal the climate as well.
All right, well, fun to check in with you and hear what's going on. Katie McGinty, VP and Chief Sustainability Officer over at Johnson Controls, joining us via Zoom in Philadelphia. But you do feel like it's making sense. It's providing financial incentives as well for companies and buildings to do this. This is Bloomberg.
good afternoon. 4:53 on Wall Street. I'm Charlie Pellet. We'll look at some of today's company headlines. We're keeping an eye on Lululemon shares. After ours, Lululemon is dropping lower than expected profitability, raising concerns about a pileup of inventory, while the yoga wear maker's full-year sales forecast disappointed Wall Street. Broadcom shares are up by about 2.5%. It delivered an upbeat sales forecast for the current period, indicating that demand remains strong from corporate customers and the cloud infrastructure industry. Again, after ours, shares of Broadcom, ticker AVGO, they are up now by about 2.5%. The Federal Trade Commission is seeking to block Microsoft from acquiring Activision Blizzard, alleging that it would, quote, enable Microsoft to suppress competitors to its Xbox gaming consoles and its rapidly growing subscription content and cloud gaming businesses. Today, we saw shares of Microsoft. They did advance today. We had Microsoft shares gaining, while shares of Activision did move lower. Activision down by 1.5%. Microsoft today up by about 1.2%. After 5 losing sessions, stocks snapped back today. We had the Dow, the S&P, and NASDAQ all advancing. S&P was up 29, higher by about 0.7%. The Dow today up 183, up by about 0.5%. NASDAQ up 123 points today. That was a gain of 1.1%. So those are some of the company stories that we are following this hour. I'm Charlie Pellet. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, we've got more Business Week coming up in just a moment. First up, though, let's get an update on world and national news. Off to D.C. and Nancy Lyons. Hey, Nance.
Thanks, Carol. The White House says Brittany Griner is in good spirits and in generally good health. Griner was released from Russian custody today as part of a prisoner swap. Meanwhile, National Security spokesperson John Kirby tells Bloomberg the U.S. is not giving up on bringing back retired Marine Paul Whelan as well. He is in Russian custody, charged as a spy.
We're working on Mr. Whelan yesterday. We're working on him today, and I can guarantee you tomorrow and every day after that, we're going to continue to try to find a way to get Mr. Whelan back home with his family where he belongs.
Kirby says the deal to bring back Griner was the only deal available at the time. Another attack is being investigated on a Duke power facility, this time in Ridgeway, South Carolina. It comes just as power was restored in North Carolina following a shooting attack on 2 substations. Former Homeland Security Secretary Jay Johnson tells Bloomberg these attacks on the electric power grid are exposing one of the nation's weaknesses.
I don't know that we can have 24/7 armed guards around every substation in America. The key has to be redundancy. It shouldn't be the case that an attack with apparently rifles on 2 substations takes out as many as 75,000 households.
Former Homeland Security Secretary Jay Johnson speaking on Bloomberg Balance of Power. No damage or injuries have been reported in today's South Carolina attack. The House has passed a bill that would provide federal protection for same-sex marriage. The vote was 258 to 169 today, with 39 House Republicans voting in favor. The bill now goes to President Biden, who says he will quickly sign it into law. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. Back to you, Carol and Tim.
Thank you so much for that update, Nancy Lyons. Really do appreciate it. Let's get over to Joe Matthew, who's standing by to get a preview of what's coming up on Sound On, which happens at 5 p.m. Wall Street time right here on Bloomberg Radio. Joe, standing by in our D.C. newsroom. What do you got planned, Joe?
Well, we're back in D.C. from Atlanta with, boy, a whole different story. To think we were talking about a runoff election yesterday. You heard about this Brittany Griner news. Guys, she's almost home. And it's been a remarkable day. We got this call at 6 o'clock in the morning without a clue of what the president was going to announce. And we're going to be joined in a moment by a former assistant U.S. attorney who actually represents Americans detained in Russia now, and his inside view on actually how this whole prisoner swap happened.
What do you want to know from him?
Well, I'll tell you what, there's a lot of things I'd like to know. Number one, what does this mean for Paul Whelan? Is it possible that this will help him come home? What does it mean about so many of the other Americans? You'd be kind of surprised. They are not alone. They're just not as famous as Brittany Griner. But what a touching moment to see her wife today, Sherelle, at the White House. It's really something. And we're going to dig inside this, see how it actually happened.
All right, looking forward to it. Joe Matthew, he's the host of Bloomberg Sound On. That's coming up in just about 2 minutes' time, less than 2 minutes, right here on Bloomberg Radio, 5 p.m. Wall Street time. All right, Joe, thank you so much. Speaking of Griner, Brittany Griner, that is the most read story on the Bloomberg in the past 8 hours. It has been there all day.
Yeah, it's right at the top there. There's another newer story out by our own Courtney McBride and Josh Wingrove that talks about the one-on-one Griner swap string unease alongside elation. And it gets to what Joe Matthew talked about, because there hasn't been a deal yet for former U.S. Marine Paul Whelan, even though overall this deal was celebrated by much of the Democratic Party, while opening the president to criticism that the deal was lopsided and risks detentions of more Americans abroad.
All right, the most read story in the past 60 minutes, Citigroup's ultra-wealthy clients, they are plowing money into fixed income. So if you're wondering what the wealthy are doing, folks, that's where they are going. And it's been an interesting week for the Treasury trade. We've seen investors moving back into the Treasury trade and those yields, especially at the longer end of the yield curve, backing off. So family offices and rich clients have been snapping up bonds lately, according to David Balin, his chief investment officer at Citi Global Wealth. They manage about $700 billion of customer assets. So bonds getting some
Get a little
love.
bit of love.
Yeah.
It's about time.
Yeah, some recognition.
Right?
It's been a rough environment. We'll see if the Fed changes that next week when they do their last meeting. All right, folks, that's a wrap. If you missed anything, be sure to check out our Bloomberg podcast feed. You can find that at Apple or at Bloomberg.com. For Tim Stanovic, I'm Carol Masser and the whole Bloomberg Business Week team. Have a good and safe evening.
I'm Caroline Hyde at Bloomberg's World Headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up this hour, the FTC is front and center. Federal regulators looking to block Microsoft's $69 billion acquisition of Activision Blizzard, saying the tie-up between the Xbox maker and the game publisher would harm competition.
Plus, the FTC has opened its campaign to block Meta's acquisition of a virtual reality company. We had the story straight from the San Jose federal courtroom.
And pressure builds on Elon Musk and his bankers. That's as they consider providing him with new margin loans backed by Tesla stock to replace the riskiest Twitter debt. We've got details of that later. But first, after scoop after scoop after scoop coming from Bloomberg, we've got to get to the macro markets for just a moment, because at the moment the S&P 500 is actually pushing higher. We've got a change of tune in terms of risk assessment. Why? Is it the jobless claims data that came in, just showing that actually data in terms of jobs is weakening somewhat? We are getting more people filing for claims. We are therefore seeing perhaps a rolling over and maybe a more cautious Fed going into that. The NASDAQ, of course, is where we see some of the money move. We've got the NVIDIAs, the Apples leading the charge. Ed, I know you'll do the micro as you always do so well, but we're up more than a percentage point. Basically, this is the best sort of day since November the 30th. Not backdated that long, but we are seeing the volatility index, the good old VIX index, a fear gauge, if you will, still languishing at about 22, many feeling that that fear gauge will have to push higher, will go back to the more 25, 30 range. At the moment, perhaps this is just complacency within this market as we see the volatility just pull back. Flick it on. Is it volatility that's managing to avoid what's happening in crypto? Bitcoin actually now is getting a nice little rally in the last day. We're up about 2%. It's small relative to what volatility we're usually used to in the crypto market. But the OG of the crypto space is having a push up higher. This is largely, though, on the back of dollar weakness. This is we, again, just reassess where the Federal Reserve might go overall, Ed. And that means dollar weakness for the first day in about 5 days. Bitcoin on the upside having its best day in at least a month.
Yeah, it's interesting. We've been so focused on the news cycle and the headlines driving specific stocks, but we forget earnings season continues. Broadcom, really interesting. It kind of is bucking the trend still in the chip space. Remember, it did it last quarter. It had a strong quarter just gone and a fiscal first quarter outlook of $8.9 billion of sales, slightly above what the street was looking for, but the street likes it. We're up 2.6%. Remember, Broadcom does have chips that go into phones and consumer electronics, but also looking at data centers as well. Some areas that are holding up better in terms of the the end products that a lot of these chips go into. We'll continue to monitor this, I think, Caroline, throughout the show in case we get commentary on the earnings call about what's happening out there, right? About some of the end markets that we necessarily don't talk about as much. But that said, there is individual pressure. Tesla continuing to basically face a flurry of headlines. I know we'll go through them in the show. The one overnight that we think is putting pressure on the stock is a cut in production hours in Shanghai, which is interesting. Datadog up 8% after a board member bought $13 million worth of shares, and then Microsoft Activision, the really big story here. Actually, Microsoft reacting positively to the idea that the deal may not happen because, of course, some investors may not think it's the financially best decision, but Activision Blizzard falling because the FTC did what we thought the FTC might do.
Yeah. They've stuck to the promise. They're going tougher on big M&A, particularly in the tech space. Lena Khan, of course, promised that, and she follows through. Ed, let's dig into all of this in DC. We want to follow the news. We want to get to where the regulators are looking to block that $69 billion deal. And, of course, it's all about a question of competition, whether or not it would be harmed by this deal. Leah Nyland has been breaking this. You had the scoop, Leah. In fact, before we got the announcement from the FTC, just talk to us about the reasoning behind this decision.
Yeah, it's really interesting. I mean, a lot of the focus in the Microsoft Activision deal has been on the console market, but the FTC said that it's actually not as worried about the console market as it is about where gaming might be going in the future, which is into subscriptions and the cloud. And they said that's a major reason why they have concerns about this deal is acquiring Activision is going to give Microsoft a great library of games that will give it sort of an insurmountable lead in these two sort of emerging markets, given that Microsoft also already has some advantages with its, cloud-based service, making it a little bit cheaper for it than other gaming companies to offer this kind of a service.
Leah, and yet, Microsoft have been trying to get ahead of this, been trying to do deals, a decade deal done, of course, just yesterday with Nintendo for access to Call of Duty. And we understand that they sat down with Lena Khan yesterday to try and explain their reasoning. It seemingly hasn't landed.
No, I mean, the FTC, particularly under Lena Khan, has been very, very worried about the sort of deals that the tech giants are doing. As you mentioned, today the FTC started its lawsuit against Meta over the acquisition of a virtual reality startup. The Microsoft folks came to DC. They had offered a lot of concessions. I mean, not just these 10-year deals with the other console makers. They had reached an agreement with the Communication Workers of America to offer labor neutrality if any of the gaming studios wanted to unionize, which they thought, the FTC would look kindly upon. They had also offered some conditions related to employment non-competes that they thought the FTC would like, and that was not quite enough to do it for him.
In the end, I guess, Leah, those conditions or offers that Microsoft made are academic, right? They weren't enough. What's the timeline from this point? Just because the FTC has voted in this direction, it doesn't mean the deal's dead.
No, this is, they voted for an administrative complaint. That means that from here it goes to a trial within the FTC before the FTC's in-house administrative law judge. That sort of a process is going to take several months. Probably we would not have a decision, an initial decision, until next summer, next fall. And from there, Microsoft can still appeal several times. So this is by no means the end, and Microsoft says it intends to litigate. This is not the only regulatory approval they need. They still need approval in the UK and also in the EU are the two main other ones. And neither of those jurisdictions were going to make a ruling on this deal until at least the spring, March or April. So Microsoft is still going to keep forward with moving towards regulatory approval there as it tries to litigate here in the US.
I kind of love this story because there's a process that happens, but there's also fighting talk. I saw headlines crossing the Bloomberg from Activision CEO, for example. What is their public position, the companies, about what they want out of this?
Yeah, I mean, both companies have said, we want this deal to close. We want this deal. We think it's good for consumers because it expands access to gaming in ways that they wouldn't have now through these cloud and subscription-based products. Right now, Activision does not have its games on any of these subscription-based products, and so obviously this would expand access. Both of them say that they're committed to fighting for now. The deadline for the deal isn't until next summer, so they'll probably have to look at it extending it because of the length of the FTC's process. But they might be willing to do that.
Bloomberg's Leah Nyland. Caro said it. Fantastic reporting. Thank you. All right, let's move on to San Jose, where federal regulators are opening their campaign to block Meta's acquisition of the virtual reality company Within. Bloomberg's Alex Barinka is down at the courthouse. She's been there all day long. What was the story of the day, and how did things play out?
Yeah, so they started opening statements. Witnesses are starting right now. And the big story of the day is the FTC is trying to kind of push this novel argument uphill to prove that this deal could hurt future competition in the virtual reality fitness space. You were just talking about the Microsoft Activision, also looking at future competition. This is kind of a torch that FTC chair has been taking, saying, look, we need to get the regulations right now before a company has a monopoly. So they tried to make that argument. The FTC also laid out some really interesting evidence showing their case that Meta was building a VR fitness app internally, and they scrapped that. Actually, when Apple had some interest in the company they ended up acquiring, they scrapped that instead to acquire the company called Within. And in doing so, they basically took a potential future rival, that internal potential app that Meta would build, off the table, and that's what hurt competition. So some back and forth there on both sides in terms of what the two litigants are pushing for.
Talk to us about the back and forth from Meta's perspective. How are they trying to argue that, look, they weren't actually building something internally?
There was charts and there were words. They basically threw up an org chart saying, look, from Mark Zuckerberg all the way down the chain, it was a no at every step in terms of the effort to build this internally. It was only a brainstorming exercise. And then they realized that actually building this app internally, there were too many obstacles. It was too hard to do. So the best course of action was to go out and acquire. We also heard Meta's counsel, Mark Hansen, come out and say, look, this nascent competition argument the FTC is making, they think that they have no evidence here, and that it could have a chilling effect on any vertical deals in the future, because companies might be afraid to go out and buy companies they don't compete with just because they're big, because the FTC might then get involved. So some real pushback there, saying, look, the core of the FTC's argument is not true in terms of what the layout over the next 8 days.
I think that's so important that you really bring the context more broadly here, Alex, because this isn't just also about the nascency of this particular type of technology, but also the nascency of Meta's own pivot into the metaverse. What does it mean for them, the fact that they've pegged everything on this space and they're being stopped from doing inorganic growth in it?
And Meta is a company who has pushed into new spaces through acquisition. We saw that with Instagram. We saw that with WhatsApp. So you can imagine that them going out and acquiring an app like this is meant to layer on top of their Oculus, which was also an acquisition headset, to move into this space. They are a year in to being renamed Meta after the metaverse, which is the virtual reality world that they're working on building. It is a strategy that Mark Zuckerberg has caught a lot of detractors coming his way. The stock is way down because of the money they're pouring into this. So this kind of test for them in this court, they say if the judge blocks this, if they award the injunction, they're going to walk away from this transaction. So pretty high stakes here for Meta in terms of what they're trying to build in virtual reality, which they say is not only the future of Meta, but the future of computing in general in the next generation of the computing era.
Alex Barinka, it has been so good to have you on the ground there in San Jose. We thank you so much. And look, Ed, we've got to break it down. We've got to go throughout the FTC's focus on M&A, and we can do that with a perfect guest, American Antitrust Institute President Diana Moss, down in D.C. Diana, today just is emblematic of what currently it feels like the administration's focus on M&A, particularly within technology. We shouldn't be surprised. Lina Khan has steered us this direction. But what do you make of the doubling down from the FTC at the moment?
I think this is very much in keeping with the chair's promises and the Assistant Attorney General's promises to really take a hard look at the digital sector, and for good reason. You know, the digital sector has grown dramatically in the last 20 years. They are coming off an acquisition spree that peaked in about 2014. It is absolutely a growth by acquisition model as opposed to a do-it-yourself model. It's sort of the buy or build question. So with the digital business ecosystems, that is the name of the game. It is to acquire and grow largely through acquisition. And both the Microsoft Activision and the Meta Within are really, really good leading examples of this growth by acquisition strategy and the competition problems that they raise because they are very large companies with dominant positions.
Diana, that word, competition, that's the bit that I think consumers, investors struggle to understand, or at least struggle to sympathize with the FTC with, right? Is the FTC doing this because it wants to foster competition? In other words, have many players in the metaverse, which, let's be honest, isn't a real thing yet, or they want to prevent monopolies? Or is it the same idea?
I think they're the same idea, right? The antitrust laws in the United States are designed to promote and preserve and protect competition for the benefit of consumers and workers and smaller businesses that might be trying to get a foothold in markets or expand in markets. Of course, that rationale, which is very consumer-facing and worker-facing and smaller business-facing, can run up against rationales for why companies might think they need to be bigger to innovate more or innovate more quickly and be more dynamic to ultimately bring new products to market and serve consumer demand. So there is a very strong tension there. But in the digital sector, I think the balances have tipped, as we've seen in these two cases, but also the DOJ's case in Google, the FTC's case in Facebook, and several state cases that there is a significant dominance problem in some of the leading digital tech players, and that competition really needs to be scrutinized very carefully. And M&A, of course, is one of the leading ways that these companies grow.
Diana, do you have any sympathy for Within in this instance with Meta and the startup Within? You know, one thing we've learned is, of course, that the metaverse is a nascent idea. It needs capital, you know, access to talent to grow and to continue. Are you worried that there will be an over-stifling of innovation if bigger tech companies aren't allowed to go out and acquire smaller companies?
So that's a really good question, and it comes up a lot in public discourse. What is the better pathway to innovation? Is it to encourage competition by smaller rivals, independent market players, and have them grow into significant market players that could then challenge these incumbent companies, right, the large digital techs? Or is it, and we do that through promoting antitrust enforcement, or is it to provide a pipeline or a feed of these startups and smaller companies into the big digital ecosystems, knowing that they will be acquired and claiming that somehow will increase the ability of companies to increase innovation? There's a real tension there. But I think the balances have tipped. And for example, in the Meta Within case, the purchase of Within, which has this leading VR fitness app, Supernatural, takes out a really important source of competition in a market that already does not have very much competition. So we worry about that when you eliminate competition in an already concentrated market. In the Microsoft Activision case, that acquisition also eliminates important competition on the outside of a digital business ecosystem. And we worry about those acquisitions when there isn't already a lot of competition. So if you're in the camp where competition serves the interests of innovation, or in the other camp, which is we need big companies to acquire smaller companies to continue to innovate, that really frames out the debate.
It's also an interesting debate to be having as we head towards basically a real pullback already upon us in terms of VC funding, a real pullback in terms of the free money that we were all so used to. And I'm wondering, what ways do we tend to see big companies that are sitting on a ton of cash be able to foster innovation in the space they want to see grow, if it isn't just by trying to do deals and actually acquire them outright?
Right, very good question. And again, the growth by acquisition model really serves as a funnel for a lot of the free cash that companies have. But I think you have to look a little bit deeper at the culture of the companies, at the way the digital ecosystems are structured with a platform, with lots of cloud technology, where we've seen lots of acquisitions in the last many years, but also these constellations of apps that exist in the ecosystem. That's a complex business model, and it's the value proposition, and it's really supercharged. So if you have market power in a platform or in cloud technology, all of those pieces of the ecosystem work together where market power can be leveraged throughout the ecosystem. And so that complicates the innovation story as well. And in fact, my supercharge incentives to buy smaller rivals, because by buying a new application like gaming content or VR app content, fitness app content, you're able then to connect that content to the platform, a platform, and to supercharge it with value with cloud technology. So it's a very complex business proposition. It's a value proposition, but also poses really complicated problems for antitrust enforcers in crafting complaints. But the ultimate concern, I'm sure as you know, is that all of this gets locked up in a single ecosystem, which makes it very difficult for smaller rivals to get into those markets.
I think, Diana, we're just starting this conversation, and we'll certainly continue it in the weeks and months to come. American Antitrust Institute President Diana Moss, thank you. Coming up, Elon Musk under pressure as bankers struggle to find buyers for the Twitter debt used for the purchase of the company after the billionaire promised to turn around its finances. This is Bloomberg.
Elon Musk's bankers are considering replacing some of the riskiest and therefore the costliest debt that he led on Twitter with new margin loans backed by Tesla stock that he'd personally be responsible for repaying. It's actually but one of three pretty big Bloomberg scoops surrounding Tesla today. And Ed, as always, you were behind a couple of them. Just run us through some of the other stories at play when it comes to Elon Musk.
Yeah, I mean, the debt burden's important, right? $1.2 billion of payments annually, so there's something he had to give there. The other two are that Tesla's cutting production hours in Shanghai, so the market's a bit worried about demand in China, which is the biggest EV market currently. And the second, as we reported, the China chief at Tesla is moved to Austin to kind of get things going there, which is a really interesting time when everyone's questioning what is Elon Musk doing any given day with which company.
Yeah, and rumors swirl as to his leadership at all these various companies. And we want to get back to the reason that people think he's distracted, which of course is Twitter. And Sonali Basak was one of the bylines on this scoop that came out last night and just has continued to fascinate us today of the debt Talk to us a little bit about how much pressure this shows that all of them are under at the moment.
Listen, the unsecured part of this debt is the part that the banks are most worried about. They had promised an interest rate of 11.75%, and we know that junky debt, risky debt, junk debt here has really gotten much more expensive for the banks to be carrying. So they could take real losses here because of that promised rate there. Remember, there's a benefit here potentially, and this is just a discussion that the bankers are really having here, for Musk to be doing this, and that one benefit would be to really start to lower that burden of that $1.2 billion worth of interest payments he would have to make annually.
Which is more than Twitter revenue, right?
Yeah, EBITDA last year, absolutely. So, you know, if you are paying more than you're essentially making, it is a very difficult burden to be taking on as you're trying to turn the ship around. Now, I want to like shadow this a little bit with the scuttlebutt that's going on in Wall Street right now, why this matters so much. Because as the banks try to offload this debt, you have the buy side really negotiating just so hard to bring the cost of that debt down, because a lot of big firms would love to be buying this debt cheaply, 60 cents on the dollar, maybe less. The banks are like, no way is that happening in our lifetimes, hopefully. But because if they did that, they would have to take bigger and bigger losses. But the negotiation, if they were to sell this debt below par, which might happen, is one option. But the other option here could be these margin loans.
Yeah, well, the market's changed since April. Don't ask me what it's going to look like throughout my lifetime. Bloomberg, Shanali Basak, thank you very much. Coming up, no booze, no politics, and no competitors. We discuss the many advertising bans of the new Disney Plus ad model subscription. This is Bloomberg. Let's get to Disney's streaming service, Disney Plus, which has debuted its ad-supported service, coming with strict rules: no alcohol, commercials, no political spots, no ads from competitors, Caro.
Interesting, isn't it? Because it's about a month on from Netflix's ad-sponsored one, and they do have a beer ad, Ed.
Right, but they've learned from their experience with Hulu, where they already have ads, just half as much now on Disney Plus. We'll be right back. This is Bloomberg.
2021, against almost any measure, it was a record year, not only in terms of the amount of funding going to private companies, but the number of deals that were actually done. So we were moving at a pace of almost 100 companies being funded every day. In a lot of ways, it felt like there was too much money chasing, despite the fact that it was so many deals, too few deals.
Oh, where we were in 2021, Ed. CB Insights' Brian Lee there. And interestingly, actually, as we keep talking about the slowdown in VC funding at the moment, amid all the concerns, we actually learned that PhonePe today, it's the Walmart-owned digital payments brand, is actually seeking as much as $1 billion from the likes of General Atlantic and Tiger Global, Qatar Investment Authority, and Microsoft. So it seems that some deals potentially still getting done if you're the right size, right space.
Yeah, the headline is that the value overall globally, VC value deals down, right? But actually what we learned from the pre-Queen data, we learned from CB Insights in the last 24 hours is that it does depend on geography. So in that case, that deal's in India. In China, the dollar value is down 50% in 2022 year on year. In USA, it's 45% according to pre-Queen. But those are just two markets. So the question, I guess, is where is money still flowing? Where's the opportunity? Which subsectors? And luckily, you know, we can talk about this all week long if you like.
Yeah, we're going to keep on talking about it until the year is done, until the next year is through. But we've got the perfect guest to talk about it in the here and the now. It's Nizar Tahani. He's with us, Director of Research at PitchBook for more. And just talk to us about what you're learning at PitchBook, what you're seeing in terms of the great highs that we came from, what 22 and now looking into 23 is going to look like for VC checks.
Yeah, I mean, it's been truly an astonishing couple of years. And I think as you look forward over the next 18 months, I think the most important thing to do is actually look backwards and get a sense of what's happening over the past couple of years in the venture markets, which is in a lot of ways led us to where we're at today. And so if you think about the dry powder numbers, so money that hasn't been invested yet in vehicles, there's $560+ billion globally. And I think the narrative over the past couple of years was that even in the case of a downturn, you were going to end up in a world where there was enough money to help supplement the industry and prop it up. Yet if you pull that layer back a little bit and you take a look at what's happening under the hood of the fundraising numbers, what you see is the majority of that is actually in late-stage vehicles. You know, we've raised $1.5 trillion, right, over the last 5 years, and that's more money than we raised in the 20 years before that. And so you've had this enormous run-up of capital that's really bottlenecked. And so I think the story of venture today, it's actually a story of concentration. So when you have money raised in the late stage at that capacity, if you think about where it's going to go, it's going to have to flow into larger check sizes. And so over the last, call it 6 or 7 years, you've seen the median check size and the average check size literally triple.
Yeah.
And then if you think about where that money's flowing from a company size perspective, you've seen 46% of the entire market cap of venture capital effectively sitting in unicorn companies. And that's relative to 16% just a decade ago. And one of the things I think is really interesting is if you take the total value of unicorn companies and you run that against net asset values of the entire global venture market, that value is actually twice the size of the entire net asset value of venture. So what that tells you is that the money that's been flowing into these companies, it's not even coming from the venture ecosystem. And so what you've seen is that you've got corporates that are actually buoying a lot of these transactions and non-traditional investors. And I think